Citi, I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Happy Friday. Well, stock futures are in the red to start this Friday because of some mixed results that we're getting from the banks. Let's get to why we're seeing this downward movement. Shares of JP Morgan and Wells Fargo, both of those stocks are falling on net interest income concerns. For shares of Citi, they're actually moving higher in the pre-market. You're looking at it on your screen there, beating on both the top and bottom lines.
That's right. Plus, a fresh read on the consumer. We'll get a pulse on how confident Americans are feeling about the economy with the University of Michigan's Consumer Sentiment Index. That is out at 10 a.m. Eastern Time. So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Madison Mills, Jared Blickery, and Dan Halley have more.
America's biggest financial firms kicking off first quarter earnings season, but we got a mixed picture here. JP Morgan, Wells Fargo, and Citigroup all posting better than expected results, but only Citi bringing in better than expected net interest income. And that is the key metric to watch because it shows us the profits that banks are raking in from charging higher interest rates in this higher for longer environment that we are in. Shares of JP Morgan and Wells Fargo were turning to the downside off of that news.
Plus, stocks are poised to close lower after a roller coaster week. Markets pulled back and bond yields soared after a hotter than expected CPI report prompted investors to reassess expectations for Federal Reserve policy. And with big banks' earnings in focus, tech has lost its winning ways from Thursday's close.
And semis are off this morning. Chinese officials are warning their telecom carriers to do away with American chips by 2027. This is according to the Wall Street Journal. This would have direct impact on both Intel and AMD. Now, shares of both companies are off more than 2%.
Our top story today, big banks, JP Morgan Chase, Citi, Wells Fargo, all kicking off the Q1 earnings season. We got a mixed picture here, as you can see on your screen. Yahoo Finance's Madison Mills is with us at the desk to break it all down. Maddie, perhaps we kick things off with JP Morgan, the largest of the banks that has reported here.
The largest of the banks and the credit giant when it comes to the big banks, right? So the question for them is if they weren't the ones to be able to beat on net interest income, that raises a bigger question. And as a reminder, we look at net interest income because it indicates to us how much these banks are being able to charge customers for our credit that we have on loan from these banks. So net interest income for JP Morgan missing just ever so slightly the analyst estimate. They also raised their expense guidance for the year by $1 billion. So the combination of those two things pushing down those shares. The big question here, whether or not they have kind of squeezed all the juice that they can out of the consumers who are putting their credit online with JPM moving forward and what that means for the bank. I talked to David Hollerith about this, who covers banks for us. You can find all of his great coverage on the Yahoo Finance platform. But he told me that the stock reaction to JPM in particular is really weird because their net interest income was based on a 3 interest rate cut anticipation for the rest of the year. And as of this week, we don't necessarily know if that's going to be the case. So they could be revising up that net interest income moving forward, which makes this downside of a little, we're at like 3.5% here, a little bit intense for JPM, given that there wasn't a lot of other bad news in their print.
Yeah, Jamie Dimon adding within this report, many economic indicators continue to be favorable. However, and this is where there's a smidge of cold water. Looking ahead, they remain alert to a number of significant uncertain forces. Global landscape unsettling. Terrible wars, violence continue to cause suffering. Geopolitical tensions growing. That's only going to be more in the spotlight, especially as we go into the elections in November as well here. So that's something that he continues to keep tabs on. Plus, persistent inflationary pressures, he cites.
Yeah, certainly. And Brian Sazzi has a good write-up here on the blog just talking about some of the interesting points that we are getting from the latest here from Jamie Dimon and the CFO at JP Morgan. They were talking a little bit about a recession risk, and Jamie Dimon went on to tell Sazzi and a group of reporters that were on this call that he is not predicting a recession. So that is very important to point out because some of the language, some of the warning, the rhetoric that we have heard from Jamie Dimon, what was in this release, what was in his shareholder letter, earlier this week, predicting what would be a volatile, maybe a couple of months ahead, given all of the uncertainty, the geopolitical risk, obviously uncertainty surrounding what the Fed is going to do here and what that means not only for JP Morgan and the larger banks, but what it means more broadly for the the economy. So I wanted to point that out as well. And there was also interesting comments here made just expanding on that a little bit more broadly, saying that the point on rates being higher on their own isn't that important. What is important is why. Is it because of stagflation? That's obviously a negative. Or is it because of healthy growth? And that's actually pretty good. So very important to point out there just the discrepancy there, or really clarify a couple of the statements that were made earlier this week in the shareholder letter, and also what was included in this earnings release. So putting it in perspective that yes, there is a reason to be a bit cautious at this time,
right,
but doesn't necessarily signal doom and gloom, not only for big banks, but the broader economy as well.
Yeah, I've been keeping tabs on Citi here this morning. The shares, it's interesting. We're seeing shares higher, but pairing some of those gains here just a little bit, it was up 2% on the initial move higher after the company reported revenue of $21.1 billion. It's actually a 2% decline from the prior year, but up 21% from Q4. What jumps out to me in this report, and it's hard to classify this as anything but a year of transformation for Citi. They have said it themselves time and time again. And one of the things that I get reminded of is the fact that, oh yeah, they just had a massive restructuring that they announced earlier this year. Thousands of jobs, about 7,000 jobs impacted by that. They're saying that it's going to be complete by March here. We'll see what they say on the call as well. But one of the other things in this saga as it continues here, they're also looking towards some of these savings in those actions, allowing them to continue to fund additional investments in the transformation. Now, where those investments are, that should come to light, especially as they've already had the opportunity to really convey that to investors. One of the other interesting areas here, and I look at Citi as a barometer of the personal banking as well here, because of the consumer aspect, branded cards here, and the way that people are spending, where they're tapping cards or swiping cards just a little bit more, as perhaps they're not deploying as much cash, just with the likelihood or thought of any type of recession that they're trying to hedge their own home or household or small business finances against. That's where Citi would be tracking some of these card revenues. Branded card revenues actually increased 7%, driven by interest earning balance growth of 10%. Payments rate, though, that continued to moderate, and spend volume growth of 4% they also saw there. Retail service revenues also increased by about 18% during the quarter.
Well, and quickly, something for investors who are looking into which of these banks you want to be positioned in right now, just to point out a head count piece that we got across these banks. Citi still restructuring, like you mentioned, under Jane Fraser's leadership. They're cutting 20,000 jobs. We have the numbers from JP Morgan, though. The bank reporting 311,000 workers this quarter. That is a beat from the previous quarter as well, and indicates this kind of fortress mentality that we've heard about from Jamie Dimon. And perhaps that strong balance sheet is giving them the opportunity to pour that capital back into the firm in terms of headcount moving forward.
Yeah, certainly. And also what it was a string or a common theme here among these large banks is also what we're seeing within the investment banking division, and some positivity there, some, I guess, glimmers of hope, if you want to say what this could potentially signal about IPO activity, what it could signal maybe about an uptick across the board when it comes to deal making. When it comes to Citi's numbers specifically, that was what really jumped out to me. Jumped 35% in the quarter to $903 million. We also saw a big jump at JP Morgan, and also a big jump at Wells Fargo as well. So guys, let's get into what we're hearing from Wells Fargo, because this is a stock that is under pressure this morning, disappointing on a couple of metrics. Net interest income, a theme here that we've been talking about this morning, and for good reason, given what Maddie had just said about the importance of net interest income and what exactly this means for banks, given the fact that obviously it's the difference of what they earn on assets versus what it pays on deposits. That actually fell quarter over quarter, coming in just below what the street was expecting here. So that drop, it is a bit worrisome here for banks. And I also want to point out that the bank reiterated on Friday that its net interest income could fall 7 to 9% this year. So reiterating that in their earnings call that is happening here just moments ago. And a little bit more specifically on that, their CFO saying that it's certainly challenging these days to forecast net interest income, given all of the volatility that we have seen across a number of data points. The second thing I want to point out, Maddie, within this report is $1.1 billion in net charge-offs, $187 million tied to a commercial real estate. We know that there has been some concern about Wells Fargo, their exposure to CRE. So $187 million of the net charge write-offs were tied to commercial real estate. And then also just expenses. When we talk about the turnaround plan that's taking place right now at Wells Fargo, we know expenses is certainly a key component of what is happening under Scharf right now, and really where his focus had been. Expenses totaled $14.3 billion, and that was actually worse than expected. So some concerning points here for Wells Fargo. I let it off with the fact that, hey, investment banking was a positive sign here for the bank, but we're seeing a lot of the bigger points here, key data points within this result really weighing on the stock here today.
Well, it's a really good point because bringing up the IB space points out that there are these different sections of each of these banks, and depending on the performance of one, that can outweigh the declines that we're seeing in others. When we look at Wells Fargo in particular, right, their non-interest bearing deposits, so that's just you putting your money in the bank and you're not earning anything off that money, that slumped 18% in the quarter compared to the same period a year ago. So that's that deposit flight that we're hearing about, with folks realizing, hey, interest rates are higher, I could be making money off of this in a high yield savings account as opposed to just keeping it in my bank. All of the banks are facing that issue, but when you have a company like JP Morgan, they're able to offset some of that deposit flight because they can charge consumers who have credit with them so much more because of higher interest rates, and they are the credit card giant, so they are able to kind of outweigh that deposit flight a little bit because of that. So just continuing to see these different sectors of the banks really mattering in this higher for longer environment.
All right, Maddie, thanks. While we were talking, Brad had to jump up. He's over at the big board taking a look at some of the market moves that we're seeing as a result of this. Brad, what do you got?
Yeah, landed fresh over here at the Wi-Fi Interactive. I just want to start off by giving folks a view of where we're trending as we're asking for or looking for a trend here over the past 4 days and coming into the start of today's trading activity. We are down for the Dow Jones Industrial Average. Of course, that trend that we're looking for is definitely highly correlated to the Fed and the trend that they're looking for in trying to get inflation down to that 2% target. However, with the prints that came in this weekend, CPI lingering large, looming large over the market psyche, that certainly had a lot of impact as we started Wednesday's trading session. So all these things considered, we are still in the red for the Dow Jones Industrial Average. I'll take a look at the futures here just to give you a look at that very quickly here as well here. That's not the futures. There we go. Dow futures, as you're seeing right now, down by about 0.75%. So that's the setup coming into today's trading activity. I'll also give you a quick look at the S&P 500 as well here. And over the course of this week, and let's put this on this 4-day chart here, you've seen that moving lower by about 0.1%, trying to make back some of that ground here. Earnings kicking off with banks, as we were just mentioning a moment ago. And then just lastly, I'll ride out with a look at the Nasdaq 100 over the past 5 days as well, largely green, but still a larger question of what a later rate cut could look like for the rest of and the broader markets. And so a lot of investors pricing that in over the course of this week. Futures, as we mentioned, moving lower this morning after results from the big three banks underwhelmed investors. So what do the results signal for the broader markets and the economy? Let's bring in JJ Kinahan, who is the IG North America CEO, to help answer that question. JJ, great to have you here in studio with us. I'll jump over to the set in a hot second, I promise. But we got to know, as you get these prints that come out over the course of this week and we begin a new trading or a new earnings season, what is the theme that could prevail as we hear more about what CEOs are saying about the macroeconomic backdrop, whether that be in travel like Delta or whether that be in banks like we've seen with JP Morgan, Wells Fargo, and Citi this morning?
Yeah, I think that this is, every earnings season, of course, what the CEOs say is probably one of the more important factors. But a lot of times you're looking at the earnings themselves. What we're looking at this time, though, and I think if you think about JP Morgan's earnings this morning, one of the reasons that the stock fell after the earnings came out is some of the statements that were around it. Mr. Dimon talking about the fact that there were a lot of factors that I'll say were out of their control that could affect things, that they had to, I'm paraphrasing, of course, but they had to prepare for a large variety of outcomes. That's not something you normally hear. You normally hear we're going to stay with this plan, et cetera. So I think there's so much going on in the macroeconomic environment. You guys just had a really smart discussion about interest rates. The interest rate environment has really been the most confusing. It's what's been driving the markets. You guys talk about it, every day because it is such so newsworthy. You look at just looking at June and September right now. If I look at the CME Fed Watch tool and see what's happening in terms of expectations. Mm-hmm. The expectation of a June rate cut is now down to about 23%. What's more interesting to me is I look out at September, we have about a 76% probability of a rate cut. But having a 50 basis rate cut and staying exactly the same as we are now is the same probabilities. To me, that's really incredible considering we're saying that June has such low probabilities overall. So again, I think that's why the market is struggling a little bit here in terms of trying to figure out what this actually means.
So what do you think is likely going to be the action going forward? If we, in fact, maybe don't get any rate cuts this year, will we see more pressure on the markets, or will we see maybe the sell-off that we saw earlier this week really just be a blip in terms of some of that longer-term momentum then to the upside?
If we don't do anything on rates, I actually think we have a nice opportunity to stay in a trading range. The one area that I worry about if this happens is going to be, of course, the Magnificent Seven, because I think that, that's down to a magnificent 2 or 3 at the moment, perhaps. But again, will they be able to hold this support as we go higher? And as I said, the Magnificent Seven, I both saw you look at each other. So
it's practically
clearly,
the final four now.
Exactly.
But you mentioned it might just be down to 1 or 2. I guess what are one of the 2 names that you think would be able to weather a higher for longer environment better than the others?
I think that the 2 that really stand out to me are Microsoft. It's interesting. I look at even our clients' behavior, through Tasty Trade, and that is Microsoft is always just a perennial favorite no matter what is going on. They are such a strong franchise overall. They've, as you all know, they've been incredible in AI, et cetera. And the other one is Amazon. And the reason I say Amazon primarily is just because if you think, I think we tend to underestimate how many businesses they're actually in. Mm-hmm. And one of their businesses seems to me is always doing well.
When you think about how investors are trying to position themselves best in a no rate cut 2024 perhaps, what is the top trade that you see emerging right now? And is it more piling into some of the overcrowded trades that we've seen, or is there some divergence that's starting to emerge?
No, we're starting. You see a little bit of a divergence. So one thing to keep in mind with retail investors, when the market sells off, they tend to trade a lot more indices and index-related ETFs, SPY, QQQ. When we see the market start to rally or continue to rally is when you start to see more divergence. And in the last few weeks, what's been really interesting to me, the stock that's been most bullish over the last week has actually been GE. And, talk about going old school.
That's one of your top picks right now, too.
Yeah, old school with the new business, if you will. And so that one has been really interesting to me to see as the top, most bullish one. The other 2 that kind of stand out are Newmont Mining, obviously related to gold, and, then we see Meta as a 3rd one. So I didn't mention that as one of the Magnificent Seven. I just think that's a stock that, they came out earlier this week. They had a couple of really big upgrades, and they talked about some of the more controls, I guess you'd say, for teenagers online, and I think that resonates with a lot of parents.
And just lastly, while we have you, is GE just the thesis that they've finally been able to split up and kind of make sure that they can delineate between the financial and kind of grouping together electric versus, power, renewable energy, GE Digital, energy financial, and whatnot, and separate those?
Yeah, and you see GE Healthcare actually doing well also. So this is one where the parts were much greater than the sum, it seems.
All right. JJ Kinahan,
Thanks
IG North America
guys.
CEO. Great to see you. Thanks for joining us. China is reportedly now looking to completely phase foreign chip makers out of its telecom systems by 2027, according to the Wall Street Journal. Shares of both Intel and AMD are sinking on the report. Yahoo Finance's Dan Halley joins us now with the details. Hey, Dan. Dan, I think we're going to get your audio squared away just real quick here if we can. Let's try to unmute you. Let's try it again.
Sorry about that, guys.
There we go. Hey, bing bong.
Yeah, it's Friday. I'm partying a little too much already. Yeah, I mean, this is, look, a big deal, but not a catastrophic deal for Intel and AMD. The telecom industry relies heavily on their chips, both Intel and AMD, to power their servers. But increasingly, this is according to the Wall Street Journal, the government officials are pushing to get those chips out and have them replaced with local made chips by the likes of Huawei, for instance. Now, prior years, that wouldn't have been an issue because Huawei chips simply couldn't keep up with what Intel and AMD were capable of. However, that's changed. And despite U.S. export controls on Huawei or on capabilities for Huawei, the company is still managing to produce chips that are in line with what's necessary for telecom carriers. So this would be a problem, obviously, for Intel and AMD. Shares were down, I think, 2% for both companies last I checked. But I think the broader thing to look at is that when it comes to servers globally, Intel and AMD are the CPU makers that everybody seems to go with. So, while China does make up a bulk of revenue for Intel, for instance, the majority of that is coming from the client group, not necessarily the data centers group. So people buying PCs, companies buying PCs, things like that are equipped with Intel chips as well as AMD chips. Part of the problem is that government officials are also trying to get their organizations to go with PCs, laptops, desktops that don't have Intel and AMD chips in them, have homegrown chips in them. And that could be an issue in the long run. Though, to be fair, there's far more people who are non-government officials than are government officials. And, when we had our kind of run of government agencies banning TikTok, it was, well, it's just government officials. People can still use their own devices and look at TikTok. And the same thing goes here. While they may not be able to use Intel chips on the job, they would be able to use them privately. So it's going to be kind of a toss-up. I think that's why you're seeing a relatively muted reaction to this news. Otherwise, shares might be down a little bit more. If it was a blanket ban, obviously that would be catastrophic for both companies. But at this point, we could start to see more agencies kind of pull back on Intel and AMD. And look, we did the same thing to Huawei. Don't forget, we had our telecoms pull them out of the ground as well.
All right, Hallie, thanks so much for breaking that down for us. Again, we're looking at pressure across the board this Friday morning for a number of those larger chip manufacturers. Thanks. Well, coming up, BlackRock reaching record assets under management in the first quarter, sending the stock higher. It's up just about 0.2%. We will break down those results when we come back.
Time for some trending tickers. BlackRock shares rising after beating expectations for the first quarter. The company's assets under management also climbing to a record $10.47 trillion, which was a 15% boost from a year ago. You're taking a look at shares on your screen. They're higher by about 0.4%, so fractional gain. Lawrence Fink, a.k.a. Larry, the chairman and CEO of BlackRock's momentum continues to build with accelerating client activity and line of sight into the funding of significant wealth, institutional, and Aladdin mandates as well here. He also mentioned later on that this is a growth company. And I find it hard to believe that a company with trillions of dollars in assets under management is still in growth phase, but that's what he believes, or at least that's what they want to tell to the street right now.
Yeah, they are. That certainly is their message to the street here today. And speaking of growth, they're saying more specifically that they are seeing significant growth potential in infrastructure, in technology, in retirement, and in whole portfolio solutions there. So that strong pipeline is what they see driving the momentum of BlackRock here going forward. And when it comes to the results from BlackRock and the street's quick reaction to this, we mentioned the fact that it actually beat its adjusted earnings beat here for the quarter. Assets under management essentially in line with what the street was looking for. And KBW summed this up as the beat was lower quality in nature, but better than feared. And I think that's why we're seeing this move to the upside, but we're not seeing a huge move to the upside given the context that we're getting from some analysts here this morning. And Larry Fink was extremely positive, talking about the strong pipeline, saying that it is the best breadth that the company has ever seen. So putting into context that he expects some of that momentum to continue here. They expect to continue to grow their assets under management, and that, he says, is going to be driven by infrastructure, technology, and retirement as some of those main drivers.
A lot of people heard me say Aladdin. They're just like, why is this guy talking about a Disney movie? No, it's their risk management software that BlackRock powers. And so it's kind of the software management platform that they have in that play within the portfolio as well.
Let's talk about a big mover here yesterday. Great job clarifying that.
I didn't want to confuse people. I didn't want them to think a magic carpet ride was coming for them anytime soon. All right, we got to go.
That's been a good analogy, too. All right, let's take a look at Apple, because reportedly doubling down on new AI-focused in-house processors for its entire Mac lineup. This is according to a report from Bloomberg. It fueled the tech giant to its best day since May, so in nearly a year, climbing over 4%. Closing just above 175 a share. You can see a bit of a movement lower here to the downside, with the rest of the broader market action under a bit of pressure here ahead of the opening bell. But when it comes to Apple, the excitement that we saw yesterday, certainly a reversal from the pressure that has plagued the stock since the start of the year. We talk about it being one of the worst performers, or among the worst performers, second to Tesla only, in the Mag 7. A lot of that being weighed down by the fact that investors were struggling to really figure out where that next leg of growth was going to come from Apple. So any sort of development, any sort of positive steps on the AI front, at least it looks like for investors, that's enough to get excited now.
Yeah, I think it's really going to be interesting to see how they build off of some of the momentum that they had seen last year. It's going to be tough comps, number one. IDC and certainly with the smartphone OS market share that Apple was able to attain and grow to, it's going to be a question of what's the next iteration to build on top of that. You're also going to be facing geographically a more sensitive customer mindset, or a more stringent customer mindset, especially looking across and looking at the Asia-Pacific region. And I think that's one area where investors might be a little wary of the growth story there. That's why you're seeing such a hard pivot into India, whether it be in retail, whether it be in manufacturing as well. And I think that's going to be where Apple has a lot of major capital expenditure that goes forward. We should be set to hear more about that in this earnings period.
All right, well, we are just minutes away from the opening bell on Wall Street. Keep it right here. Again, we are looking at futures lower for all three of the major averages. We'll be right back.
Wow, big bell energy on this Friday. Take a look at the Nasdaq and the New York Stock Exchange. Got a lot of happy folks, smiling faces in different places there. Nasdaq, Midtown Manhattan, and then in the financial district, you've got the New York Stock Exchange, where it looks like UL Solutions, ticker symbol ULS. ULS, that's what I imagine they're cheering down there. Anyway, they're ringing the opening bell.
You guys are hype man today.
I mean, obviously they do. And just ESMA, the European Security and Markets Authority, they just need more hype people up there. But it looks like they're having a great time anyway. All right, that's the opening bell. And taking a look at some of the moves out of the gate here, we're still down across the board right now, Shauna.
We aren't seeing a huge move here at the open. A bit of a difference in what we've seen the last 2 days on the heels of the latest inflation prints. You've got the Dow just below the flat line. You've got the Nasdaq, though, off about 0.9%. Let's take a look at the 5-day chart. You can certainly see we are well off the lows of the week. We certainly did get some excitement yesterday, but we're not seeing too much movement here today. And then the S&P moving to the downside here just at the open, off just about 0.7%. And it's flipping back to the Dow. Now we're getting a little bit more movement. The Dow off just over 200 points. We got to talk about financials. First, just the sector action more broadly speaking, what we are seeing there. It is a lot of red on your screen. You've got technology among the worst performers, but financials, pull it back up. You got it. All right, and now we're looking at the S&P. We're all over the place because everything's changing here at the moment. But again, when you take a look at the financials, we're seeing a bit of pressure when it comes to JP Morgan, when it comes to Wells Fargo. A lot of that over concerns of net interest income and what exactly that could signal here going forward.
Absolutely. All right. We're continuing to take a look at what else is transpiring within the markets. We've got Yahoo Finance's very own Jared Blickery. He has also got the interactive loaded up. We'll just let you take control, Jared.
I got more boxes, so this is going to be a great game of whack-a-mole. Let me find first where gold is standing, and we're going to put our commodities heat map on the interactive behind me. And by the way, in the upper left here is coffee. We don't talk about some of the softs, and cocoa would go in that group, but we've really seen a lot of commodities just accelerate to the upside here. But what I'm looking for first is crude oil. Now, this is a 3-day look. Let me put it 5-day, and we can see how we are at the highs of the week. And in fact, we are at the highs since late last year, and this has mainly been a sideways consolidation. Things don't get exciting until we punch above 95. That would be this resistance level here, but not there quite yet. The IEA, and here's the news of the day, the IEA is upgrading its demand forecast, and there's lower demand. They are expecting globally demand growth expected to be about 1.2 million barrels per day this year, next year falling to 1.1 million barrels per day, and that's coming from a level about 2.3 last year. So we are definitely experiencing lower growth. Nevertheless, that total figure is supposed to be 105 million barrels a day. That's a lot of oil right there. Now, also want to take a look at gold. Gold is at another high. Let's see if I can find GC equals F. And there we go. This is a 2-year look, so you can really see the break to the upside here. But I'll just show you what has happened this week. The 5-day look in gold, well, we saw a little bit of a slump on Wednesday, Tuesday into Wednesday, and then it was just off to the races again. So nothing seemingly stopping gold as it heads for that next big number, $2,500, perhaps.
All right, Jared, thanks so much for breaking that down for us. Let's take a look at small caps because once again, they're opening to the downside here today. And this follows what has been a downbeat week here for the group. It triggered by a hotter than expected inflation print out earlier this week, making investors adjust their rate cut forecast, pushing off the likelihood that maybe we won't see a rate cut until the fall. Well, going into this year, the group of stocks were poised to deliver potentially to the upside on hopes that the Fed was going to start easing. But that hasn't exactly panned out so far. So what is ahead? We want to talk about that with our next guest. And joining us now here in studio, we want to bring in Greg Atordo. He's with Goldman Sachs here to break down everything that we have seen within the sector. Goldman Sachs Asset Management Portfolio Manager. I want to get your title in there, Greg. So let's talk about some of the downward pressure that we are seeing in small caps this week. Anything to be worried about, or is there still a reason to like the group?
I think that there are a lot of reasons to like the group. You have a nice earnings cycle starting. You have a lot of M&A and IPO, undercurrents that will ignite animal spirits. And I also think that you have some pretty unique thematic trends in retail and restaurants and some parts of the technology cycle. I think there are these, kind of weekly, it seems, Fed, tape bombs that come out, and that's something we all have to be prepared for. But the underlying strength in the economy is something that always does drive small caps. It's a very domestic asset class. very much driven directly by what's going on in the U.S. economy. So the strength in the U.S. economy should not be discounted in small caps.
What do you make of consumers right now and how they play into the demand profile that we're going to hear from a lot of companies over the course of this earnings season as well?
Yeah, it's been pretty uneven in terms of some of the companies that have come out. Some of the apparel companies have not done well. I mean, I think if you look at the credit card data and some of the other alternative data that's out there, it's not as negative as what you've seen from from some of the more recent results. You have seen some interesting traffic pickup, but there's been some volatility around here because March was a really tough weather month, and it wasn't just regional; it was around the country. I also think you had a time shift for Easter, which did change some merchandising plans and things at the retail level. But I do think overall, you haven't seen a diminution in spending, from the consumer, and I think it's one of those things that you will see it in a much more bifurcated way as the year goes on, because the consumer has changed their patterns. I think that they still want to travel, they still want experiences. I think that the apparel piece of it has to be something that's very much driven to them, in their gut, as opposed to just kind of replacing something that doesn't need to be replaced.
Greg, what happens if the Fed doesn't cut rates this year?
Well, I think if the Fed doesn't cut rates this year, I think what we'll see is kind of a GDP environment closer to 4%, which is probably a good place to invest in. I think you do sap some of the tailwinds for some of the more speculative assets. I do think that small caps are often seen as a speculative asset class, but we've had 2 tough years relative to large caps, so there's a valuation opportunity as well. So I think that may come into play as soon as we get kind of closer to the presidential election period. So I do think that it may take out one of the pillars that's underlying the small cap story, but I don't think it takes most of them out.
Is there a smart way that investors can aptly trade small caps beyond kind of taking into portfolio account as well the unprofitable small caps that are out there?
Yeah, it's a big issue for a lot of people. I think that if you buy the benchmark or you buy the indexes, I think what you find is there's a lot of stuff in those places you just don't want. There's Russell 2000 has 1,900 companies, and a good chunk of them don't have profits and probably never will. And some of them, some of the ones that are out there don't have profitability in their sights because they're spending on some really interesting things. You also have some lower quality companies, the former SPACs of years past that are in there. And I think that if you follow a more quality-oriented approach as we do, I think that you find that the over-indexation towards profitability is something that allows you to be kind of better than the benchmark over time.
Greg, we talk a lot about the fact a lot of the momentum this year has been driven by AI. That was the fact also for 2023. And a lot of that has been attributed, or I should say really benefited the large caps. Is there an AI trade for the small caps? Is that group going to benefit from AI as well?
We think the picks and shovels piece of it will start to really manifest itself. It's been very singular, kind of with the large caps, out there. But I think as it gets broadened out and more of the large players get in there, you're going to need more chips. You're going to need companies like Onto Innovation, one of the companies in our portfolio that makes the advanced packaging process for high bandwidth memory, which you need for all these NVIDIA instances that are out there. There are other companies in the space that make cabling and other semiconductors, one that went public a couple of weeks ago, that we really like, and they're really tied along that that same hype cycle curve that's out there that's growing very fast. We think we'll start to see some software productization as well amongst these companies, and I think that there are many of these players that will be able to monetize this, especially in the enterprise, because the enterprise, they're not going to buy everything from the from the behemoths. They're going to want to do some things that are purpose built and really unique to what they do, and we see a number of opportunities out there in the software space.
Greg, thanks so much for taking the time here with us today.
Thanks for having me.
Absolutely. Greg Torto, who is the Goldman Sachs Asset Management Portfolio Manager here on Yahoo Finance. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Consumers continue to crack open a cold one on Friday night. Why not? Boosting Constellation Brands sales in its fourth quarter. Net sales in its beer segment jumped 11% in the quarter, driven by the popularity of the Modelo Especial brand. Joining us now is Bill Newlands, Constellation Brands CEO, plus our very own executive editor, Brian Sozzi. Bill, they were cracking open these beers on far more than just Friday nights, clearly by these results here. All things considered, I mean, we were joking about this yesterday. I mean, my spirit animal is doing Duolingo and also cracking open a Modelo at the same time. Wondering what some of the catalysts are that you saw in this quarter.
It was a great quarter, and it really finished up a great year. Last year, we were named by Circana the #1 CPG growth company, and that was the 5th time in the last 7 years. So clearly, a lot of people are cracking open a lot of our beverages. So we were quite pleased with it, and Modelo led the charge. As you all know, Modelo took over as the #1 beer by dollars in the U.S. last year, and it's just been on fire. It's been phenomenal.
Yeah, Bill, after this week in markets, that's Brian here. I could use about 8 Coronas. I mean, it's been one hell of a week. But look,
help yourself. I mean, it's a great idea.
You have the email address, Bill. But look, really, I mean, a lot of companies and leaders in packaged foods, the industry lately, have been talking about consumers pushing back on price increases. When you look at your business line by line, do you see signs of consumer caution?
We don't, but part of what I think has worked to our advantage is, and we've talked about this before, we were a little more judicious over the course of the late pandemic about not over-raising our prices. In fact, we got some heat for that in some instances. But our big thing was we didn't want to lose consumers. And we have great brand loyalty, which is obviously an important part as well. So we have been relatively immune to that because of that great brand loyalty, and I think our approach to pricing over time, which has been well received at a consumer level.
Bill, you talk about great brand loyalty. I'm curious just the confidence that you have right now maintaining that increased market share, whether or not, or if we do see Bud Light sales get a bit stronger, what does that more specifically then could mean for your business?
Well, fortunately, we have a lot of things going in our favor. You know, Pacifico was up 17% last year. Our Chelada business was up 30% last year. We're extending our Oro business, Modelo Oro, which was our light beer with only 2 SKUs last year, was the #1 growth driver. It was terrific. So, you know, we have a lot of avenues to continue to grow our business. And now we're introducing a number of things from our innovation. Aguas Frescas, which did a phenomenal job in the Nevada test market last year, is being expanded to roughly 70% of the country. And Brian, you'll probably like this, we're testing Corona Sunbrew this year in the Northeast, and you can probably get some. It's going to be a phenomenal new product that I'm very excited about. So we have a number of avenues to continue the excitement on our beer business.
Yeah, I would like that, Bill. Actually, I mean, yeah, I will happily give that a try. I want to ask you about the wine business. It's still not where I imagine you want it to be. Is it the reality that we are just in a continued era of beer chugging? People just love their beer, they're going to drink their beer, and they just don't want wine. And then as a company that has a wine portfolio, I mean, how long can you stay committed to this?
There's no question that there's been some challenge on the wine side of our business. Part of what we've done, and we did a fairly deep dive in the last few months, is we're going to spend a lot more time and focus on the critical brands that matter. We've got about 11 brands that represent 80% of our portfolio, and they're things like The Prisoner and Meiomi and Kim Crawford and High West. And we're going to spend a lot more time and energy against those critical brands. They're higher on the price ladder. The biggest challenge in the wine business has been in the mainstream. But we've also got some tricks up our sleeve around Woodbridge, which is in the mainstream and one of our bigger brands. So, we also named a new leader, as you probably saw just recently, Sam Glaetzer, who brings 30 years of experience in the wine business. So we're still very bullish on that. We think our strategy's right. And we're looking forward to seeing improved results here as we move forward.
Within the wine business, Bill, look, I have a lot of wine snob friends. It's their thing. It's their hobby. I know squat about wine. When you diagnose the brands that you have, is it a labeling issue? Is it the taste of the wine? Is it that the mainstream consumer is just drinking Modelo?
Well, I think it could be a little of all of that. You've seen some softness, but you tend to see the softness at the lower end of the business. The premium and luxury ends are doing fine. they're a little off their peak, but they're doing fine. So, and we've seen these ebbs and flows historically. I think the important part is that we continue to focus our attention, do some price pulsing where necessary to give the consumer some extra value. And again, this is part of the benefit of what we have with brands that are strong and have good consumer recognition. That's very important in a market that's a little bit more down than it's been historically.
Bill, just lastly, while we have you here, a World Finance report found that Gen Zers, they're drinking on average 20% less than millennials. I wonder how Constellation is trying to get ahead of the shifting taste profiles of that next generation.
You bet. That's been a very interesting discussion. One of our best intros from last year was Corona non-alcoholic. It was the #1 growth driver in the non-alcoholic segment. So that's one example. Aguas Frescas, I think, will speak very much to flavor and betterment. You know, those are two areas that are more important with that consumer base you were just mentioning. But so we think there's a lot of things that we've got coming up that are going to create some differentiation and opportunities for that consumer that's looking for a little something different than perhaps the prior generations have.
All right, Bill Newlands, always great to speak with you. Thanks so much for making the time to join us here, CEO of Constellation Brands.
Thanks very much for having me.
And of course, our thanks to Brian Sozzi as well. All right, coming up, we will take a deeper dive into big bank earnings. We got mixed results out this morning from JP Morgan, Citi, and Wells Fargo. We've got analyst reaction for you when we come back. Well, Q1 earnings season officially underway for the big banks. We've got a set of mixed results here this morning. Let's take a look at how the sector is trading. And as you can see, there's certainly a lot of red on your screen. We've got to start with this downward movement that we're looking at in shares of JP Morgan. That's off just about 4.7% here in early action. You're looking at a 5-day chart here, pulling up a 2-month chart here. You can see the bit of a reversal with today's decline. And we're having the worst day that we've had for JP Morgan in just over a month, I believe. So again, important to keep your eye on that and that trading action here today. When you take a look at Citi reversing some of the earlier gains that we initially saw right out of the gate, taking a look at the 2-year chart to better illustrate the drop that we're seeing here. And you can see shares lower today, off just about 0.4%, despite the fact that overall the results were pretty strong, showing that the company has been making some moves in the right direction in their transformation story. And then wrapping it up with Wells Fargo, reversing some of its earlier declines. We're now actually trading just in positive territory, up just about 0.1%. But net interest income, that was one of the concerning parts of this report. So keeping those gains in check here. The same you can say about JP Morgan as well. Brad?
All right, thanks so much, Shauna. We're pulling out the common thread on the banks here this morning, and that's examining the differences between how each bank is able to withstand the Fed's higher interest rates. Net interest income across all three firms down in Q1 from Q4. Here with more is Saul Martinez, who is the HSBC head of U.S. Financials. Saul, thanks so much for taking the time. We know it's a busy morning for you as well. You've been able to hop on the calls here and listen into what the executives have to say. What most notably sticks out to you from the tone and what you're hearing from these bank executives right now?
No, thanks for having me. Well, we've only had JP Morgan's earnings call thus far. So we're still waiting on Wells Fargo, and we're still waiting on Citi. Obviously, the results for all three of them are out. I think the outlook for net interest income is important. I think there was some expectation that perhaps JP Morgan and Wells Fargo would increase their outlook for net interest income. And JP Morgan kept the $90 billion net interest income guidance, which, I think, if you think back to the first quarter, we had 6 rate cuts priced in. Now we have around 2 rate cuts. So I think there was some hope that that change in the rate outlook, coupled with the fact that JP Morgan has been fairly conservative in their net interest income guidance, that would lead to an increase in the outlook. And the tone is in my view, was somewhat cautious. They are still saying that they feel like there is going to be pressure on deposit pricing, that maybe that they are over-earning on deposits. In other words, the spread over deposits has been abnormally high, and that will continue to normalize. So the tone on that point, I think, was a bit cautious, and I think that's what's that coupled with the expectations going into the quarter, and just a view with JP Morgan, they tend to do, they've tended to have very strong results and also continually increase their outlook, and the fact that they didn't in this backdrop, I think, surprised some folks. So I think that part was important for Wells Fargo. Also, the net interest income was a little bit soft. I think there was some hope that their guidance for net interest income of declining 7 to 9% would be increased. They kept it. But some other parts of their quarter were strong, and this was true of all three who have reported. Investment banking was strong. I think overall expense management was pretty good as well. So I think there's a little bit more of a mixed bag with Wells Fargo, despite the fact that they didn't increase their net interest income outlook.
So I'm curious what you make of the improvements that we have seen within investment banking, what you just mentioned there, and that was true across the board for all three of these banks. Do you think that signals any sort of optimism just about deal activity, what we could see in the IPO market to come, or is this just off of more depressed levels?
I think there is some optimism here. If you peer into the numbers, what you had this quarter was really strong debt capital markets issuance. And JP Morgan highlighted that there may be a pull forward there of activity, and the sustainability there might be somewhat questioned. I think on the other side, things, equity issuance was better. It really will depend on IPO activity and whether that continues. I think pipelines are good. The M&A side is sort of the interesting dynamic because it was depressed even in this quarter, and even though announcements which haven't closed, that's when you get paid is when they close. have been moving up. But JP Morgan kind of threw a little bit of cold water, or at least expressed a bit of a cautious tone there, indicating that the regulatory backdrop remains really challenging, and there's some uncertainty as to whether that will, whether you will see a very strong rebound there. I tend to be a little bit more optimistic. I think if you look at investment banking relative to historical normalized rate levels, given the equity uptick or the increase in asset prices and equity prices, I do think you will see, greater investment banking activity, which bodes well for others, including Goldman and Morgan Stanley, over time. It's still a question mark as to the strength of that recovery and over what time frame that occurs.
Saul, just lastly, we only have about 20 seconds left here. Should investors be confident in the year of transformation over at Citi?
I think so. I'm positive on Citi. I think you'll see better cost performance into next year. I think it was encouraging that they kept their $80 billion revenue guide. I think credit was good. The market side was good, was pretty good. So I'm positive looking forward, and I think they're hopefully on track to deliver better results into the back end of the year.
All right, Saul Martinez, HSBC's head of U.S. financials. Thanks so much for taking the time to hop on with us on what is a very busy morning. Thanks so much, Saul.
You're welcome.
Well, coming up next hour, Madison Mills joins me here at the desk. We are going to break the latest reading on consumer sentiment. That will be released in under 2 minutes. And we will take a deep dive into big bank earnings. You're looking at pressure across the board. JP Morgan actually having its worst intraday performance that we have seen in just about a year. Coming up later in the show, we will talk all things energy with the CEO of Generac.
And I'm going to be back here at 11 a.m. Eastern Time. Our new show, Wealth, 11 a.m. every day. Today is all about last-minute tax tips. Is this what you've got on the docket for your weekend? The filing deadline is Monday. So you have 3 more days to get your paperwork together, folks, or file an extension. You don't want to miss what our experts have to say on this. Stay tuned. Happy Friday. You're watching Yahoo Finance.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We got some breaking data out for you. University of Michigan's consumer sentiment coming in below expectations, falling to 77.9, the preliminary reading for the month of April. That was below the street's expectations and down from the prior month of 79.4. So a bit of a decline here in this index for the prelim reading. Now, consumers perceived a little change in the state of the economy since the start of the new year. And a couple of other things I want to point out within this report. The increases in inflation expectations were modest enough that consumers do not appear worried that high inflation will come roaring back. Also, that consumers are fully aware that inflation has come down substantially since 2022. They are not, though, satisfied by the current pace of disinflation. So the pricing, obviously, the fact that pricing still remains elevated at these current levels, worrying consumers to a degree here. And as a result, we're seeing consumer sentiment fall a bit from the previous reading, the prelim reading, Maddie, coming in at 77.9. That was down from 79.4 the prior month. And again, we're still looking at losses across the board for all three of the major averages.
We are looking at those losses, Sean. I was just trying to pull up so that I could get an indication here of the degree to which the market is dropping, specifically off of that consumer sentiment index report here. We see that we are getting a little bit of a red candlestick after that, not as much to the downside following those bank earnings from this morning, which of course are going to be pressuring these stocks today. But as you mentioned, we even have the tech-heavy Nasdaq down 0.8% so far this morning, which is particularly interesting given that we saw a buying the dip, buying that pullback sentiment coming in from traders yesterday after stocks fell on Wednesday. So I'm curious to see to what extent we start to see a change in that throughout the course of the day today. I want to see if I can get a look at how we've seen the Nasdaq performing over the past 5 days here. Yes, you are starting to see that dip coming in this morning. So the question remains as to whether or not that's going to continue throughout the rest of the day here. But as I mentioned, stocks falling after those big bank earnings kicking off this morning. We had shares of JP Morgan, Citi, and Wells Fargo. They were moving after this net interest income concern coming out here. Now all of these stocks moving to the downside. Citi had been up earlier this morning. Looks like now after digesting that report, we're seeing it coming down a little bit here. To discuss more of this, we are joined by Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, great to meet you officially. So excited to have you on this morning. I do want to start on these bank earnings because I'm curious from your perspective, what's standing out most to you about which of these firms is able to kind of withstand this higher for longer environment, and what else is seeming like the big headline for you this morning?
Well, we think that the largest banks are the ones that are going to be able to deal with higher for longer far better than the smaller banks, which we'll start to hear from more next week. Really, the thing that we're listening for very closely from the banks is their discussion about credit health, not just for consumers, but also for corporations. How are those end customers dealing with a higher for longer environment? And what we are hearing from the likes of JP Morgan is that they keep using this term normalization, which just means that we're seeing things get back to more normal levels and territory post the pandemic, where you saw things be in very odd levels for quite some time. So think of things like credit delinquencies or the percentage of balances compared to disposable income. All of these things are getting worse, but they're just normalizing. So the biggest thing for us to watch is, does normalization turn into outright weakness, meaning that there's bigger credit issues under the surface?
Cameron, what do you think the likelihood of that is now?
I think that we're starting to see signs of fraying in those smaller businesses as well as lower income borrowers. So if you look at the aggregate numbers, it can be rather misleading. They all look still very healthy, but there are certainly signs and pockets of weakness. And it's where we're also listening very closely for as we go through this earnings season is, what are consumer companies saying about demand from consumers? We've seen this incredible ability for consumers to deal with higher interest rates, higher inflation, and just keep on spending. But are we starting to reach levels where we've seen real wage growth start to kind of sideline versus the increases we had been seeing? Are we seeing the levels of debt kind of reaching a ceiling of how much can be tolerated? If we're hearing signs of that, could we start to see consumer spending slow down? And that's very important, of course, for GDP estimates, given the fact that consumer is 70% of GDP.
And the consumer looking a little bit more frustrated with the inflation picture this morning off of that consumer sentiment index, which reminds me of Jamie Dimon not really wanting to talk about the recession elephant in the room with media this morning. I'm curious from your perspective, how likely is the recession scenario versus a potential no landing scenario?
Yeah, I mean, it's been incredible, the shift in narrative over the last 12, 18 months between the absolute certainty of a recession to now the absolute certainty of having no landing. The thing for us to watch, and we keep calling it probably the most important chart in markets right now, is GDP growth estimates for 2024. What we saw over the course of the last few years is those estimates were slashed in 22, but starting in mid-23, they started to rise quite significantly. And in this year alone, we've added about 100 basis points to GDP forecast for 24. And now we're sitting at 2.2%, which is effectively that no landing kind of scenario. So the big question is, can we stay at that 2.2% estimate? What could potentially drive it higher? Or what could be those drivers that we could see estimates revised lower, which really would be a shock given now that we have pretty much consensus completely on soft landing camp.
Cameron, what does all this mean potentially when we take into account that we could be in this higher for longer rate environment, maybe potentially with the Fed? There are odds that we might not even see a cut this year. Specifically, what does that mean for tech, which had been a leader last year? And we have seen some signs of life, especially when you take a look at some of the moves that we're seeing Google today and Apple yesterday. Is there signs, though, that they could potentially be a leader if there is no rate cut?
Yeah, well, big tech, mostly those companies with big, huge cash balances and not a lot of debt, love higher for longer, meaning that they're still earning really high rates on their cash. They're not having to go to market and refinance at higher rates simply because they termed out debt when rates were so very low. So big tech is a defensive trade in that way because of its balance sheet, which raises then the point of what do you do with lower quality balance sheet parts of the market, your small caps and other parts of the market where you do know that you have big refinancing that starts in late 24 and 25. Those are the names that don't like higher for longer. Those are the names that are going to see their interest costs go up rather significantly as they refinance, and likely is why you're seeing overall net income pressure in those low quality areas. So big tech ends up being a safety haven trade in a world where rates do stay higher for longer.
So Cameron, given that, is every dip in the Magnificent Seven buyable?
Possibly in the short term, but the thing we're watching the closest with the Magnificent Seven is that they've had an incredible run of earnings, and earnings are extraordinary for the first quarter. You have big, huge earnings jumps for Nvidia, Google, Amazon, Tesla, and Apple, not so much. But what happens as we move into later 2024 is that earnings growth pace starts to slow rather materially. You even have forecasts for earnings growth for the rest of the market being higher than the Mag 7 by the time we get to the fourth quarter. Whether that materializes or not is a question, but I think that we have to remember that markets trade on second derivatives. They trade on the rate of change of growth. And so as we see this growth start to slow down for Mag 7, will they be as attractive names? I think that's more of a question for 25, which is why dips are likely buyable over the short term for the Mag 7, but then we have to watch them very closely as we round the corner into the back half of this year and into 2025.
All right, Cameron Dawson, New Edge Wealth, the Chief Investment Officer. Always great to have you. Thanks so much for joining us here this morning.
Thank you.
Well, the big story that we're watching today is big bank earnings. JP Morgan, Citi, Wells Fargo, all in the red. Actually, Wells Fargo now trading to the upside. We're looking at gains of just about 0.1%. One of the common themes here is net interest income, and exactly what we heard from all three of the banks. It actually declined quarter over quarter across the board. And I bring this up because of the commentary that we're getting out from JP Morgan from their earnings call, Maddie, and their call that they had with media reporters not too long ago, because the net interest income guidance was really what was in focus. Not so much what we got here for Q1, but really what JP Morgan is seeing going forward. And it was something that was brought up on both calls here. The fact that JP Morgan, the bank, did not raised its 2024 full year number on changing rate expectations. Executives there saying that the net interest income outlook is not meaningfully different there. So maintaining their prior guidance there, and this causing the bank to keep its number at 90 billion. Though also the other thing I wanted to point out, which Cameron was just speaking about there, was some of the weakness that Jamie Dimon mentioned when it comes to the consumer, specifically the low-income consumer, not necessarily taking out more loans, but he has seen a bit of the fact that those consumers are pulling back on spending could be a bit worrisome here as we enter what is expected to be a very uncertain time.
It's a great point because the CFO also mentioned that of JP Morgan, talking about how they are seeing that consumers are able to withstand the inflation but because of their wages, but obviously that is applicable to one particular group of the population. So we do continue to see this bifurcation happening, and we see that throughout the earnings cycle, by the way. We'll continue to see that as we start to see evidence potentially of consumers trading down as well. So there's so many ways to kind of look at the consumer health in this market. And then we have consumer sentiment also coming in a little bit hotter than anticipated. So all of this data coming together to paint a little bit of a picture of a consumer that's starting to buckle here.
All right, we'll keep right here on Yahoo Finance. Another price target cut for Tesla. This time, it's from Citi. We will speak with the analyst behind that call. Tesla shares off 1% in today's early trading. We'll be right back. Tesla shares are off just about 1% today, extending what has been a sluggish start to the year for the EV maker. Tesla stock has actually fallen 30% since January 1st. You can see that decline on your screen. The moves have led several analysts to slash their price targets on the stock. Citi is the latest to cut its price target, lowering it to $180 a share. Well, we've got the analyst behind that call. Itai Mikhaili, Citi's U.S. autos and auto parts analyst, is here to discuss some more. Itai, it's great to have you here. So you just lowered your price target here for Tesla. The biggest concerns, challenges as to why you're seeing a bit of a more challenging road ahead for the company.
Yeah, absolutely. So we did lower the price target in our earnings estimates to reflect the Q1 delivery miss and even some early data points we're seeing in April. And so the challenges Tesla's faced recently partly are actually the outcome of their success over the years that have created somewhat of a saturated effect on their vehicle sales in certain regions like here in the US. Of course, in China, we're seeing greater competition. And the product age has also become an issue. I think the one lesson we've all learned in the past year or so is that some of the kind of age-old rules of automotive purchasing are still very much alive and well in the EV era. And that is when you do have higher levels of saturation, or when your product portfolio does age past a certain point, even price cuts don't do quite so much to stimulate demand. These are solvable issues, but right now they are having a greater effect on Tesla than what we even expected a few months ago, as we did lower our estimates to reflect that, and that of course affected the price target as well.
And Itai, you talk about potential disappointment for the upcoming robo-taxi unveiling, and this is kind of mirroring a cycle that we've started to see with Tesla, at least when we speak with analysts. They talk about how there's a little bit too much hype coming into these unveilings that end up being disappointing. Is this starting to become a pattern for them?
Great question. We'll see it on August 8th. I mean, we do love the focus they have on autonomous vehicles. We do think it is the most powerful mobility megatrend out there. And so we've been very bullish on autonomous. You know, there's really two scenarios that we kind of laid out for the August 8th event. One is kind of what you described, which is a bit of a similar event to what we saw from Tesla back in 2019 at Autonomy Day, where they reveal a robo-taxi, but without much of a follow-through for actual deployment and strategy for how to take that to market in a reasonable amount of time. The second scenario, which we, of course, more positive, is that we do see both the robo-taxi, where we actually think the company will highlight cost advantages and other kind of unique features. But on top of that, we would actually also get a lot of incremental information on the deployment strategy itself, not only on the AV tech itself, but how they're thinking about deploying this from a mobility and rideshare network. And there's actually a lot of opportunities we've written about in the past for them to deploy, maybe not so much in the densest urban centers that other companies are competing in today, but in other domains where very powerful business models can still be built upon. So we'll see what happens on August 8th. But for us, the focus is, of course, on the robo-taxi itself, the unit economics, but more importantly, on the path for deployment, the strategy for deployment. And if we can come out of there convinced that there is a path to deploy, maybe a differentiated path to deploy and build a network effect, that could become more of a positive versus what we saw in the past.
What about the broader AV landscape here when it comes to some of the other players within the space? The fact that Tesla is focusing on the robotaxi, is focusing on AV, is that largely viewed potentially as a driver for some of the other names?
We do think that the industry will adopt much higher degrees of autonomy going forward, right? There's a lot of benefits, not only from a revenue stream perspective, new revenue streams, new business models, but even just when you think about the safety benefits of greater levels of autonomy, what that could do to insurance, what that could ultimately, of course, do just to society. So that the list of benefits from adopting higher degrees of autonomy is a very, very long and compelling list. It will take some time, however, to play out. We do like the fact that Tesla is focused on this, and certainly in a market that has become more competitive, of course, the EV market globally, these incremental features not only differentiate a vehicle, but as I mentioned, do add potential for significant revenue streams. They're very profitable revenue streams from a software perspective down the line. But we do think there will be a race for the industry to adopt these incremental technologies going forward.
Who do you see as the winner of the autonomy race?
For us, in the supplier space, we've of course mentioned Mobileye has been a name we've liked a lot there because they do have leading technology and a very strong position itself. Obviously, Tesla's kind of doing their own technology and their own approach with FSD, so we're kind of watching their development pace as well. But it kind of also depends on there's many kind of ways to win in autonomy. Again, there's focusing on urban robo-taxi, very complex but lucrative domains, but there's also other paths we see for focusing on kind of easier domains, but one that you can still have pretty compelling business models. Think about a vehicle that you own that can, pick up deliveries for you, or do service overnight, or even peer-to-peer kind of lending networks that one could develop. So, we like some of the automakers within this who seem to be aggressive. Of course, GM and what they're doing on autonomy there as well is something we're watching for potential upside. But the suppliers are some interesting names there as well.
All right, Itay, we got to leave it there, but really helpful. Thank you so much for joining us and sharing with us this update on your price target here for Tesla. That was Itay Michaeli with Citi joining us on all things Tesla there. Now, Chinese officials are telling telecom carriers to phase out foreign chips. That's according to reporting from the Wall Street Journal. Sending American chip giants off of that news, Intel and AMD stocks were tumbling. Joining us to break down China's U.S. tech crackdown, Yahoo finance reporter Akiko Fujita is here. Akiko.
Yeah, Maddie, this is the second blow in just weeks for AMD and Intel. Remember, it was just last month that Chinese officials essentially directed government agencies to start phasing out PCs that use AMD and Intel chips. This morning, we're learning that China is reportedly extending that ban to telecom systems. As you noted, the Wall Street Journal reporting officials directed the country's biggest telecom carriers to phase out foreign processors in their systems by 2027. We have seen shares of Intel and AMD sliding on the back end of that, largely because those two companies have provided the bulk of those processors used in networking equipment for years, not just in the world's second largest economy, but the world. And also, China remains a big market for these Chinese makers, for these chip makers. For Intel, it's 27% of revenue. For AMD, it's the third largest market with 15% of the revenue. Now, China has been investing billions of dollars to boost domestic chip making production as it looks to reduce reliance on foreign semiconductors. And this 2027 deadline that's cited in the Wall Street Journal would seem to suggest that China believes that it can achieve a certain level of independence, at least in these core processors, within 3 years. And that would suggest a rapid ramp up in production within the country. Now, all of this, of course, stems from chip-related export restrictions the U.S. placed on China in the name of national security. And you could argue that in many ways, China is now using the same playbook against U.S. chip makers. If you'll recall, back in 2019, the U.S. essentially all but restricted equipment and technology to Huawei, which was one of the world's largest telecom equipment making companies. And then 3 years later, the U.S. Commerce Department imposed some of the strictest export controls in place, all but banning critical technologies as well as chip making equipment to Chinese chip makers. Since then, we have seen local and central governments throw subsidies at these Chinese chip makers to really ramp up their development there. And Maddie, in many ways, we've been watching Huawei as kind of a barometer to get a better sense of where China is in the chip making process. How advanced is their technology? We got some news on that note overnight when they essentially teased an upcoming launch of its high-end P series. The Mate series that was launched last year raised a lot of eyebrows because, according to US eyes, the chips involved or integrated into that device was a lot more advanced than expected. So there's going to be a lot of attention on this upcoming phone as well, all in the grand scheme of things as the US watches very closely to see where China is in their chip making ability. As China says, look, if you want to do that to us, we will retaliate and try to limit US chips as well.
Really helpful reporting as always, Akiko. Thank you so much for joining us this morning. Now, coming up, the CEO of Generac is joining us, the company known for its backup power generators. Their stock up over 30% the past year. We're going to tell you why right after the break. Taking a look now at backup power manufacturer Generac, the shares are down this morning, a little under 2%, but the stock has been on a tear, up over 30% in the past year, and those gains are outpacing the S&P. This upside does come after experts have predicted a very active hurricane season to come here, with potential for 5 major hurricanes coming up in the summer. And joining us now to discuss, we have Generac CEO Aaron Jagdfeld. Aaron, thank you so much for being here with us this morning. So we were talking a little bit in the break about the read-through of the macro inflation picture to your stock price and to the company, of course. So I'm just curious, how much of a macro impact is there?
Yeah, I think higher interest rates obviously add costs to the kinds of products that we sell. So whether you're talking about solar plus storage, or you're talking about generators, these are home improvement projects, and higher interest rates generally, make that a more expensive purchase.
And what are you seeing from consumers just in terms of spending trends, whether or not they actually are holding back on some of these larger ticket purchases?
Yeah, I think when it comes to a discretionary purchase, I think then, you will see some pullback there just naturally. I think the interesting thing about our products is when there is an outage, though, right? If you get a hurricane or if you get a large storm, suddenly those purchases that I think people think of as discretionary become, absolute necessities. Yeah. So that changes. Typically, the interest rates don't hurt us that much when we see outage activity. The outage activity was a little bit hot to start the year, cooled off the last couple of months, but we're just now getting into the season, so we'll see how it turns out.
How do you prepare for that from a supply chain perspective?
We've been doing this for a long time. So, we have to basically, we have to plan as if there's going to be a season, and there generally is. So we make our plans, we produce our products, we carry a lot of inventory as a result. So if you looked at our balance sheet, you'd see that. But that's part of what we do as a company. We're ready for the events when they happen. You just don't always know when or where they're going to happen, but we have to be ready to react.
You certainly have made some strategic moves with the company over the last couple of years, recently adding a few more acquisitions here to your business, to the portfolio. Why does that make sense? And do you expect that trend to continue just in terms of more acquisitions in the pipeline?
Yeah, for us, historically, we've been a backup generator company, right? So when the power goes out, our products go into the market, and hopefully people are happy about that. We really have thought about things on a macro basis over the last 5 to 6 years. We look at the transition that's taking place in energy, the transition in the grid, right? From the old grid to the new grid, 1.0 to 2.0 or 3.0. I don't know which version of it we're on right now, but really moving into more of an energy technology space. So broadening out, not just about resiliency, but also about the cost of energy and conservation being an important element of that.
So what changes have you made to your business as a result of that?
So we've been broadening into areas like smart thermostats as an example, right? So it's not just about backup power, it's about all the energy in your home. EV charging, that's another really important space that, as we pick up adoption for EVs, that is going to put an enormous amount of power needs on the grid. And so being able to control that and being able to manage that is going to be super critical for not only homeowners, but grid operators as well.
You also have AI putting pressure on the grid.
Well, AI is a whole new story, right? It's a whole new part of the story. And that's the needs of energy are projected to triple in AI just in the next 5 years. And it's basically the equivalent of adding like 40 million new households to the grid. So, it's a tremendous amount of power. And I don't think it's one of those areas that it's come on so quickly that I think grid operators and utilities are really struggling to figure out how to satisfy that demand.
What does it mean more specifically for your business?
Well, for us, obviously, when you see increases in demand like that, and you also have situations on the supply side, as we work to decarbonize supply side, we're retiring coal plants in favor of wind and solar, which is great, but those are intermittent sources instead of sources that can run 24/7. So grid operators really have a significant challenge ahead of them in terms of balancing supply and demand. What we know in our business and watching this kind of play out over the last several decades is that reliability is on a downward trend. So, people are experiencing more outages. And so our core business of providing backup power with generators or batteries has really been on a tear. This new element of energy cost, I think this is the thing that's coming in the future, as you try to take care of all of this added demand from AI, from EVs,
all the things that are going, heat pumps, right? I mean, we're converting everything in our homes to electrical appliances. This is going to drive reliability, probably, unfortunately, for most people, are going to experience more outages. And that's only going to be good for our business.
What do you anticipate if you were kind of looking at this from a policy perspective? What would be a helpful solution to that challenge?
Well, you know, I do think some of the policy things that have come into play here in the last year with the IRA, those have been helpful. I do think that it's really important that we get focused on, you know, trying to build up the supply chains that we need, whether it be around battery supply chains or, you know, chip supply chains. These important technology supply chains are a critical element of this, but we need to do more. We need to have, you know, from solar production, right? We need to have more incentives around solar, more incentives around battery. I do think that, you know, it's a very complex problem. The grid is 3,200 independent utility companies across the U.S., 3,200 oversight bodies. So it's almost a one-to-one relationship. Wow. And it just creates a situation where it's very difficult to make change quickly. Mm-hmm. But unfortunately, things like AI aren't going to wait for, you know, the natural state of affairs to play out in their normal course. So I do think that some policy-related things could be very helpful to help accelerate some of these things that need to get done.
Aaron Jagdfeld, we really appreciate you taking the time, especially joining us here in studio, CEO of Generac. Thanks so much, Aaron.
Thank you.
All right, well, let's stick with the energy space. I want to toss it over to our markets reporter, Jared Blickery, who is taking a closer look at the renewable space, and he's joined by SolarBank CEO Dr. Richard Liu. Jared, take it away.
Yes, and Richard, thank you for joining us here today. You just listed on the Nasdaq your company SolarBank, but you've also traded in Canada. You're headquartered in Toronto. So why the Nasdaq in the United States now, and just the timeline? Tell us about your business.
Wonderful. Thank you, Jared, for having me here. It's a great honor to be here at Yahoo Finance. And yes, we've been actually in business for more than 10 years. We listed in Canada last year, March 2023. In such a short time, we were able to deliver all the performances. And then I was very fortunate. I was able to do the direct listing yesterday at the Nasdaq. It was a fantastic experience. We had all the team members joined us, and it's a validation, it's an encouragement, it's also an inspiration for the team.
Well, tell us about your business, and you're engaged in some community projects, and tell us what you've done, but also what you have in the pipeline.
You know, I can put it very simply. We provide the energy of the future, which is as soon as the sun shines, which is renewable energy. We are in origination business. We secure the site. We do permitting. We do interconnection. At the end of the day, we are the engineering firm. So we produce the production joints. We get it built. We operate and maintain them, and also we own them. Right? So that's the whole process of what we do.
And where do these cells reside? Could they be on people's houses? Are these large industrial installations here? What are we talking about?
Excellent question. So in the business, you have residential business, which we are not involved in residential business. We put on roofs of big Fortune 100 companies such as Walmart, such as Enbridge, such as the Honeywell and other companies. So we do a lot of those behind the meter for corporate to reach their net zero gain.
Okay. You know, within the United States, there have been a lot of subsidies for solar over the years. How does that, are you able to take advantage of some of those subsidies? And then what's the current environment for that? Because congressional regulation plays a big part, and we've seen a number of stimulus acts over the last few years. Any of that hit your business?
I would say that I started this business more than 20 years ago. So, you know, you could say without the subsidy, you would not survive. But 20 years later, because the cost of renewable energy dropped so much, now actually we can compete with traditional energies. So our production costs are already lower than the fossil fuels. So because of this, there are additional incentives, for example, the Inflation Reduction Act, for example, the investment tax credit. Those actually encourage people to participate so we can get a quicker flip of the energy from fossil fuels to renewables.
You know, I'd be remiss if I didn't mention artificial intelligence in our conversation. Doesn't immediately strike me as it might be directly applicable, but AI in general is just increasing the demand for energy worldwide. Do you think in general we're prepared for the demand increase that we're about to experience, which is probably far and above anything we thought was coming in the pipeline.
I would say that civilizations need electricity. We need electron to give us light to driving all the activities. AI actually is a very power demanding technology, but that will push us advance so fast, right?
Yeah. Well, I want to ask you, we got time for one more. I'll give you the floor. Anything you want to add to the conversation here?
I would say it would be a great honor here at the most liquid market, and we're excited on the Nasdaq market. We want to work with our communities, our government, and our corporate partners to making sure that we can achieve the net zero goal in 2035.
All right, and just for the record, fossil fuels not going away completely, but we do have that net zero goal on the horizon. Thank you very much for joining us, Dr. Richard Liu, President and CEO of Solar Bank, excuse me.
Yeah, thank you.
Well, could this earnings season lift the market to new highs? That is, of course, the hope. But one technical strategist says while we could see that, we could also see the market stalling after this quarter. So joining us to discuss his call, we have Stephen Suppmeyer, Bank of America Chief Equity Technical Strategist. And Stephen, thank you so much for being here with us. I want to dig into your call here because there's obviously, like I said, a lot of growing sentiment that this earnings cycle is going to lift us to the upside despite whatever the Fed might be doing. But you think we might see a stalling after that?
I mean, I think the stalling is actually happening here and now. We've been highlighting 5200s as a potential pause point in the market, especially after that solid first quarter that we had in 2024. Few reasons why we come to this conclusion, and then we just view it as a temporary setback. We do actually think the market does go on to higher highs after that. But right here, right now, April and May in presidential election years, which we are in right now, as everybody knows, the S&P can struggle. So I think we can struggle a little bit April, May, around this 5,200 level. Maybe you need to see 5,000. There's also some big supports, 48, 4,600. Not sure if you need to go that low. But after that, when you look at cycle work based on the presidential cycle, if we do back off a little bit, there is a case to be made that you get a nice summer rally. Normally, seasonality does call for a summer rally. It's not sell in May and go away. It's actually buy May, sell July, August. And in the fourth year of the presidential cycle or presidential election years, you can have a strong rally. So if you dip a little bit here, 5,000, 4,800, and then get the summer rally, we think we could be pushing towards 5,600 by then. So, that's the way we think the roadmap works with the presidential cycle and our positive technical trends on the S&P.
Stephen, what are you seeing just in terms of sentiment right now and the positioning between institutional and individual investors? Are you seeing any sign of euphoric levels, or is it simply just a bullish view at this point?
Great question. I think at this point, a bullish view. Individual investor sentiment has been elevated for pretty much all year, but it's not at euphoric levels based on the AAII bullish sentiment survey of individual investors. And we also look at institutional positioning of institutional asset managers in S&P E-mini futures. It's very similar reading there too. It's elevated, and it has been elevated pretty much all year. So investors are now believers in the cyclical bull market that's been in place since we bottomed out in October 2022. And this is pretty much like the second phase of the market where, you would call it the participation phase where more people are involved, but not quite yet at those euphoric levels. So I would argue people are more bullish than they were a year ago, but they're not at peak bullishness, meaning contrarian bearish sentiment levels. We got a little bit more room to go there.
And talk to me about what you're seeing in money market funds as well, Stephen, and what that tells you about what we might be looking at moving forward. Yeah.
Sure. That's one reason why a pullback could be limited. Investors have a love affair with cash. And granted, cash is actually an asset class you can invest in and get a return in now, roughly around 5%. Where in the past, over the last decade or so, you really couldn't get any return there, thanks to Federal Reserve rate hikes. So cash levels can be sticky to some extent due to that, but the equity market continues to have double-digit returns, which we actually think it can. Eventually some of that money is going to come out of the cash level. So if you look at all money market mutual fund net assets, it's over $6 trillion. So some of that money likely gets put to work in this participation phase of the rally, because the S&P just broke out from its 2-year trading range in December and broke out to new all-time highs in January. So, there's cash that could be put to work to fuel this rally, towards 5,600, maybe even higher than that.
Stephen, speaking of fueling this rally, what are you seeing in the growth versus value debate? Are you still seeing growth remaining in that bullish trend? And if you are, what does that then signal just in terms of the leadership that we will likely see ultimately for that next leg higher?
Well, I think the good news is this. Even though when you look at growth over value charts, a couple things to point out. First and foremost, there are bullish breakouts for both the growth side and the value side of the market, meaning that both these indices, if you look at Russell 1000 growth, Russell 1000 value, have broken out with new all-time highs. What's different, though, is that one of these styles is leading the market in a longer-term bullish trend, aka that's growth, obviously driven by secular stories like AI. And the value side is still actually in a longer-term lagging trend. So if I had to say a bigger picture, what's going to work over time, it's most likely on a relative basis, growth stocks over value stocks. It doesn't mean that you shouldn't own anything in value. Because the market has indeed broadened out this year. Technology leadership, semiconductor leadership has been joined by energy leadership, selected financials leadership, selected industrials leadership. And given breakouts for many commodities out there, materials are starting to catch on too. So a little bit broader. So I wouldn't say it is an all or none deal for growth versus value. It's, you own some value, you own some growth, but I think bigger picture, at this point, the trend still favors growth over value overall. I just wouldn't put all my eggs in the growth basket. I would diversify, perhaps have some value names as well tied to the commodities, which are breaking out here.
Well, and for investors that are looking at that breakout, I'm curious from your perspective, how important is it to look across different asset classes, at commodities, bonds, stocks, and what does that help you suss out about the market?
Well, I mean, first and foremost, interest rates have gone from basically 0 to 5. Everybody thought that would have been bearish for equities. I think what has happened here is interest rates have been normalized. They're at average historical levels going back to the 1920s. And I think the market likes that. That is actually healthy. I think in this environment where you are getting commodities breaking out and, there's been more of a whiff of inflation in the air. I mean, you do have gold breaking out of an 11-year cup and handle formation that, some of our on the technical side, it projects about 2,800, but our fundamental strategists think you can see 3,000 gold. So, I mean, I think you got to have a diversified approach here. And I think that's what the message of the market is. I mean, the secular growth stories are secular. They should be able to work regardless of what the business cycle is. Sure, they'll ebb and flow, but over time, they will go higher. The more cyclical stuff, show the commodity stuff, breakouts are showing the market eating up a bit. So it argues that if you're trading maybe over the next few quarters or a year or so, maybe even a little bit longer, perhaps own some high beta versus low volatility. High beta does include some cyclical tech. It includes some industrial, some financials, materials, and energy. So, and if you take that ratio, high beta versus low volatility, it looks like it favors high beta. So I think we're in an environment where growth is favored over value, and high beta actually is favored over low volatility. So you're getting, more breadth in the market based on that.
All right, Stephen, we have to leave it there. Thank you so much for joining us and for sharing this research with us. We really appreciate it. That was Stephen Suttmeyer, Bank of America's Chief Equity Technical Strategist. Now, coming up, the race for electric air taxis is on. I got to take a ride in Joby Aviation's aircraft to learn more about what's next for the industry. All of that coming up after the break. not a flying car and it's not a helicopter, it's an electric air taxi. Joby Aviation says that their aircraft could take consumers all the way to the airport by next year. So I went for a ride inside Joby's air taxi simulator to learn more about what the technology has in store. Take a look.
We're going to take off. All I want you to do is pull back with your right hand. That will make you go up. There you go. Now you're flying.
I'm flying.
We're not actually flying. We're in a flight simulator from Joby Aviation, which is used to train traditional pilots how to fly this battery-powered aircraft. These aircraft are called eVTOLs, which stands for Electric Vertical Takeoff and Landing. Joby says someday their electric air taxi will get Manhattanites to JFK in under 10 minutes for the cost of an Uber X.
So we take off vertically, we fly, and then we transition our propellers, if you will. They are straight up, and then they'll transition forward. And it does it all automatically. When I fly, all I'm doing is saying, what speed do I want? It decides what level of tilt to do. So it's very simple.
Joby plans to launch commercial flights for passengers next year. The Federal Aviation Administration thinks that's possible, but 2028 is a more realistic timeline for a scaled competitive market. Either way, depending on where you live, you could get to the airport via eVTOL by the end of the decade.
And Shauna, what was so interesting about reporting this piece is not only figuring out that the technology really is there and it could be launching as early as next year as long as they get certification, but also the details. We dig so much in the piece into the business behind these air taxi companies and just how hard it is to really make a profit when you've got a big thing that you're trying to launch into the sky off of battery-powered aircraft. It's the same challenges that you see with electric vehicles you have with an aircraft, but it's got to get up to the sky.
Yeah, you would think eventually it would start taking market share from airlines, from car companies here eventually once they are approved and they are up in the sky. But I gotta ask you, what was it like flying it?
It was fun.
Even though it's a simulation, I think it would still be a little bit nerve-wracking.
It's so cool because the whole screen like wraps around you, so you can't. It doesn't seem like it's not happening. And they have things where it feels that way. Of course, I was bad at it, but the whole point is that it's not hard. And it's so easy. But I was like, I raked it back, and she was like, "Okay, you need to relax.
I would do
you
the
need
same.
to chill."
Yeah, exactly. It always makes it look easier than
exactly. You should do it next time they're here. We'll do a group trip. But be sure to tune in on Monday at 10 a.m. Eastern for that full episode of Next. That is on the business of electric air taxis.
We are looking forward to that there, Maddie. We know we've worked very, very hard, some long hours put in at the office to get this package up and running in time for Monday. All right, let's take a quick check of the markets here 90 minutes into the trading day. You're still looking at some of the losses here across the board. That selling actually accelerating here as we get the trading day underway. You've got the Dow now off just over 350 points. The S&P off about 1%. The Nasdaq, the worst performer of the three major averages, that's off just about 1.3%. Coming up next, our new show, Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. Have a great weekend. We'll see you on Monday.
We made it. Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks as well that you need to grow your money. On today's show, big bank earnings, everyone, what they mean for you and your money. Also, choosing between an EV and a hybrid or just one of those ICE, those internal combustion engines. Well, we've got the pros, the cons, and even some picks on the way. Plus, last minute tax filers, listen up everyone, with just days to go before the deadline, will help you get squared away. First and foremost, we got to talk about the big story that we're watching today. That is big bank earnings. JP Morgan Chase, Citi, and Wells Fargo all reporting results. We've got some team coverage here for you at Yahoo Finance. On Wealth, Jared Blickery standing outside the studio. He's at what we call the big monitor here until we get a better name. We'll call it the Jumbotron here, just as working title for Jared. Also, David Hollerith standing by as well. He was listening into some of those earnings calls here. Jared, we'll start with you. Let's break down what's happening to people's money in the markets here as a result of these reports.
Sure. Let's get the Wi-Fi Interactive up on the big. That's another name for it. I agree. We got to work on that. But nevertheless, JP Morgan in the upper left, that is down 5.75%. This is the biggest negative earnings reaction in a couple years. You'd have to go back to the beginning of 2022. And by the way, this is a 5-year chart. You can see that was a record high for JP Morgan. This was a bear market right here. So very, very different operating environment. It seems the guidance on net interest margin was a little light, but I'll let David get into that. Just want to show you that you can see, aside from State Street, everything on the screen here in the red. Wells Fargo also reporting. That's down just fractionally, about 15 basis points. Goldman Sachs down 2%. They're going to report next week, but you can see this is a stock that's been trading in a range over the last few years at the upper end of its range. So you got to wonder, do these banks have it in them to rally a little bit more to record highs? Well, not today. Here are the regional banks, and they're not going to be reporting till next week, but I just wanted to give a flavor because this week, and this is a 5-day look, we saw them really get hit when we saw that higher than expected CPI print. And in general, the small caps, of which they are the biggest contributing sector, have taken tumbles here. But here's the bank look at 5 days. Big banks once again. Some dark red there, so we'll have to see if they can turn it around. And we got a lot more coming next week. David?
And David, let's bring you in as well. Seems like more consumers leaned on credit cards this quarter. At least that's what Citi found. What does this say about the consumer and their finances?
Yeah, Brad, it was actually true across Wells Fargo and JP Morgan cards. I mean, and it shows year over year spending and credit card loan balances have gone up, which is it's been a bright spot for these banks in terms of loan growth for the last year. Business loans and commercial real estate loans are growing at a much slower pace. So it's pretty important for them. I'd also point out that the credit losses and provisions for future credit losses around this area also were reduced for the quarter. So it appears at the moment that the banks are seeing credit and consumers still going strongly, and then also credit looking more favorable. We did ask Jamie Dimon, CEO of JP Morgan, about stickiness of inflation, which obviously gets into consumers' wallets and could in part explain some of the behavior. And, he said, the fact that the, one reading doesn't really matter that much, and I'm paraphrasing, but also that it really depends on how the economy takes it, whether or not what we're seeing right now is healthy growth or something more akin to stagflation. So, it's kind of difficult to tell right now what higher credit card spending means. It does, of course, have a lot to do with what happened at the end of March 31st, as opposed to what we found out this week from the inflation report.
Yeah, David, I hear you got a question into JP Morgan CEO Jamie Dimon as well. Sounds like he was taking some questions from reporters, and great to hear that you had some representation on that call, as well as our own Brian Sazi. David, appreciate the time and the breakdown this morning. Well, it's easy to feel overwhelmed by bills. Millions of Americans are drowning in credit card debt, all while struggling to pay their bills on time and fight off high interest rates. Nearly 3.5% of card balances were at least 30 days past due as of the end of December. That's according to new data published by the Federal Reserve Bank of Philadelphia. So, with credit card delinquencies on the rise, how can you feel financially secure? For more on this, we've got Monique White, who is the self-financial head of Community. Monique, great to see you here. A lot of people are trying to figure out what is the first step that they can take to get out of delinquency in the face of piling up debt as well here. What say you?
Yeah, that's a great question. If you find yourself struggling with making on-time payments, there's three things that you can do. The first is to take a look at your budget, sit down and look at your credit card and your bank statements to get exact figures. Don't use projected costs or estimated amounts. Get the real numbers so that you can realistically know how much you can start putting towards your credit card debt. The next thing that you can do is to contact your credit card companies, keep that open line of communication. Now that you did your budget, you know how much you can start putting towards your payments. You can be honest and explain your financial hardship and come up with some type of payment plan so that you can get yourself back on track. And the last thing is to consider adding, additional trade lines that can add positive payments to your credit report, since that's the biggest factor of your score. And while you might not want to add any additional credit cards or loans, there are free credit building products like self-free rent reporting that can generate positive payment history that can help you build your credit.
Monique, it's interesting. We continue to talk about and hear about the resiliency of the consumer, but the way that consumers are spending is visibly different when you hear about data points like this. Help us make sense of the strength of the consumer as it relates to the economy and that difference in the way that consumers are spending right now.
Right. So, we know that people are relying a lot more on their credit cards to supplement their income because of holiday spending, higher cost of living, rising interest rates, and people are just feeling extremely stretched right now. And when you're just trying to cover your basic monthly expenses, your credit card payments just do not become a priority right now.
Certainly. Now, there are some ways that people can get their credit back on track. Let's give them some of those tips, especially if they're starting to miss payments. What is the way that they can kind of reverse the course there?
Yeah, so if you do find yourself delinquent and you're trying to get yourself back on track, you've already contacted your credit card companies, but you still feel crippled from it, you can always contact free counseling or credit coaching agency that can provide those type of free services. They can come up with a game plan. They can sit down and contact your credit card companies and find ways for you to start making on-time payments again.
Is there good debt as it relates to credit cards? I mean, we hear about good debt versus bad debt all the time, right? But as it relates to credit cards, how does that calculus differ a little bit for consumers out there?
Yeah, when it comes to consumer debt, that wouldn't be considered good debt. Any type of assets that you have would. So right now, people are just focusing on trying to pay down their credit cards, especially with the higher interest rates right now. And that's just their main priority.
When we think about the other things that go into a credit report, where else can consumers have those conversations with their institutions to figure out where there are payments that they make frequently that can also factor into their credit score and help improve the equation for them a little bit more rapidly?
Yeah, so the two biggest factors of your score are your payment history, which is 35%, and your credit utilization, which is 30%. So if you have those two things working against you, that's going to damage your score. So contact your credit card companies to see if there's a way to either erase that payment or moving forward, come up with some type of payment plan that fits into your budget so you can continue to make on-time payments. And once you see your utilization going low, you'll be able to build your score back up.
Monique White, thank you so much for taking the time here with us today. Self-financial head of Community. Appreciate the time.
Thank you.
Coming up, everyone, in the market for a new vehicle, new whip, new wheels, a new ride, as Exhibit would say. Well, we'll break down the pros and cons of building and buying an electric vehicle. Maybe not building it yourself, but an electric vehicle versus a hybrid. We've got the breakdown after this quick break. Many moons ago, when you went to buy a car, you had your choice of brands, but you could only really get one kind of car, gas-powered. Now, the more climate-conscious shoppers get two other options. You get electric vehicles, and you get the option of a hybrid. So, if you have a budget for a new car and don't know what to choose, don't worry. Yahoo Finance's very own senior autos reporter, Pras Subramanian, is here to help. So, Pras, what should we be considering when we're choosing between an EV and a hybrid?
Yeah, there's a lot to consider there between these two different types of cars. Recently we've seen EV kind of ownership and interest kind of come down, whereas hybrids has sort of exploded in terms of interest in sales. So let's take a look at what you really need to look at when you're trying to actually consider. So looking at kind of, with EVs, looking at prices, and Americans talking about how fewer Americans are interested in EVs compared to a year ago. Prices have been going up. So cost is a big consideration versus hybrids. Hybrid prices are like around 42.5 versus an EV 55-ish. So that's a big concern there. But then also maintenance, right? Maintenance is cheaper for an EV, but more for a traditional gas car or hybrid. So they're looking at that. But then also, of course, there's the insurancing. A big thing we talk about this week is insurance. And EVs generally have higher insurance costs because they're a bit more complicated to repair. But we're hearing some insurers like Progressive talk about how, as they get more data into that, they can actually bring those costs down. Real quick, also the kinds of trips that you do. If you're the kind of person that's going to be taking on shorter trips for errands and maybe going to work, the average American drives 37 miles a day, right? If that's your use case, I would say an EV is the best use case for that. If you can charge, but you can charge at home at night or at the work site or even in your neighborhood, it's a great option for these shorter trips. If you're like a person in sales and you're driving a lot, 100 miles, 200 miles a day, probably a hybrid, a better option for you. So I think that's sort of like the use cases and how much you can afford, really going to sort of weigh in on what you get. And this is like not brain surgery, but at the same time, there's a lot more options out there for you.
This is the second time this week that we've heard telematics come up in the case for EVs, especially as bringing down some of those auto premiums. And we can come back to that or discuss it at length at another day. But let's get people the nitty gritty here and the goods. I heard you had some specific picks for our buyers out there. So what are they?
We got some picks here. We got some so for instance, in the EV world, at the higher end, in my opinion, if you got the money and you wanted the nicest ride you can get, I think you can go Lucid Air if you want that sedan, really high performer out there, or if you want a more of an adventure vehicle pickup. I think the Rivian's still the top pick in that space. And those Cybertrucks out there, there's an iPhone 50 Lightning, great truck, but the Rivian is my top choice. Okay. And then for the affordable thing, you still cannot beat the Tesla Model Y, only because you can be half or so cheap, great feature set. Obviously, the Tesla supercharger network is the most ubiquitous, the best one, and it's basically an appliance, right? It's a car. It's not really like your BMW, but it's a car that gets you around town, and it looks okay.
Yeah. All right, Pras, thanks so much for breaking this down for us.
The hybrids, real quick.
Hybrids. Yes, the best hybrids. We need to know that. Yeah.
So real quick, the top plug-in hybrid, in my opinion, is the BMW X50E. That car was rated Consumer Reports' top overall vehicle, no matter what it was. Yeah. Is their top vehicle. And affordable, the Toyota Prius King. That thing has been around for 20 years. The new model looks better, has better range, more power. I think you can't lose with that car.
I've rented the BMW X5 once. That thing flies. Yeah. Dangerously. Pras, thanks so much here for breaking these down for us. People out there, they got the picks that they need to know at this point. All right, higher for longer. The fact that benchmark interest rates may not come down so fast means mortgages, loans, any borrowed cash is going to cost more. But it's not all bad news here. There are some stocks that you might want to take advantage of while they're still cheap. For more on this, we've got Keith Buchanan, who is the Globalt Investments Senior Portfolio Manager, here with us. Keith, great to see you. First and foremost, when we look at the market over the course of this week and some of the volatility that we've seen, perhaps there are some buying opportunities where investors are beginning to nibble on. What are you tracking?
Thank you so much for having me. We've looked really all year long at just how much the market has moved from having 6 rate cuts this year. It's almost 7 at the beginning of the year to 4 to now 3, maybe even 2. This last mile of inflation will be stickier, will be more difficult, and higher for longer has become, back into the lexicon of how market participants are thinking about the rest of this year. We're looking at lower duration assets. We're pulling away from higher duration assets. Higher duration assets have a lot more volatility when interest rates move dramatically, particularly on the longer end. So we're looking at value assets as well, ones that pay a yield that's higher, whether it's on the fixed income side or on the equity side. And those tend to be stickier, lower duration assets that perform well in these environments where the assumption is inflation and interest rate could be higher for longer.
For those out there that may be wondering, what are the characteristics of value stocks? What are the parameters that they should be looking for, or the checkpoints?
Absolutely. Value stocks are instruments that have a lot more cash flow or earnings per the dollar you have to pay for the stock on a price to earnings basis or price to cash flow basis or an enterprise value or EBITDA basis. There's more bang for your buck as far as what the company earns per what you have to pay for that particular equity. So that is traditionally been your industrial stocks. It's been energy stocks, some consumer stocks as well. These have not been in favor over the last several years. It's been all about AI all the time, and technology and those kind of ancillary stories, if you will. And some of those equities that come from very profitable companies have just lagged because they haven't been in favor. We're picking around those names and those stories that offer that lower duration, very durable cash flow, very durable earnings flows that offer our portfolios a lot more diversity, which we think will pay off in the coming year.
Keith, this is the second time in 2 days that we've been talking about portfolio diversification. What does a healthy kind of portioning of that portfolio diversification look like from your purview if people are looking at the percentages that they're weighted in one direction or another as it comes to their investments?
It's more for us. It's more of a sense of owning things that isn't typically in favor at all times. That's kind of uncomfortable, but that's a mantra that, from an investment perspective, we feel like is necessary, particularly in times of dramatic, paradigm shifts like we're in right now. Owning energy over the past 4 or 5 years hasn't been the sexiest place to be. Owning Walmart, names like Waste Management, haven't been, necessarily the places that everyone's talking about as far as owning equity portfolios. But we want to make sure that we're shifting away from and selling into strength of some of the AI larger tech names that have done extraordinarily well and frankly have encompassed a larger part of our main indices as we move around markets. We want to shift away from those names as they continue to win, sell winners and rotate into names that haven't done so well. And doing that on a continuous basis over the past 3 or 4 years hasn't been the way to win. We think the paradigm shift is coming now. Will prove that that age-old mantra of buy low and sell high to prove right over the coming years.
Keith, thanks so much for taking the time here with us today. Keith Buchanan, who is the Global Investments Senior Portfolio Manager. Appreciate the time.
Thank you.
Certainly. Well, consumer sentiment coming in lower in April. That's an economic indicator that measures how optimistic consumers feel about their finances and the economy. And it's not doing too well. To break down what this means, Yahoo Finance reporter Madison Mills here in studio with us. Hey, Maddie.
Hi, Brad. I'm so happy to be here. First time on Wealth. I'm very excited.
Come back again.
Thank you so much. And I really love talking about why this matters to consumers. So this is really important, right? Because we see that the consumer sentiment index dropped to 77.9 this month, down from last month's 79.4 figure. So that's not too big of a drop. The stock market's not freaking out. But what does this mean for consumers? Well, this index could be anywhere from 0 to 100. So the way I think of it is we're giving the economy, at least from a consumer sentiment perspective, a C+ grade here at that 77, almost 78 mark. And if you look under the hood, you get more details about what the consumer is feeling here. We saw that the share of consumers blaming high prices for eroding their living standards drove up to 39% from last month's 33%. So seeing an increase in that particular feeling. We also saw that consumers' perception of their current financial conditions, that hit a 4-month low. And this is part of what reads into some of those survey results we get, where if you ask people, hey, how's the economy doing? They say, yeah, I guess it's good. Jobs are up. That seems to be going well. The stock market's up. My 401k looks good. But my current inflation, my current economy at home doesn't feel good because things are just so expensive. And I think folks are still hoping to be able to go to the grocery store and have the prices that we saw in 2019. And that's just not what we're seeing in the data.
You know, it's really interesting, especially as we got the commentary from the Survey of Consumers Director, Joanne Shu, who had said a slight uptick in inflation inflation expectations in April reflects some frustration that the inflation slowdown may have stalled here. This is not the first time that we've heard this week as well.
Mm-hmm. Yeah.
All right. Absolutely something to continue to track going forward here. Thank you so much for breaking this down for us. Madison Mills.
Thank you.
Well, everyone, it's 2024. Anything you order can be at your house in just a couple of hours. I know. and a few minutes as well, but at a price. Amazon, Walmart, and most recently Target are all duking it out for your business. To break down the differences, we've got Yahoo Finance's very own Molly Moorhead here with us. Hey, Molly.
Hey, Brad. This week Target unveiled the Target Circle 360 membership program, which is meant to go head-to-head with Walmart Plus and Amazon Prime. It's a annual subscription. It gets you delivery on items to your house included in your subscription price. And before you go adding another subscription to your monthly bills, it's a good idea to compare them. And so this new program from Target is $99 a year, pretty similar to Walmart, which is $98, and Amazon Prime is $139. They all get you free same day or next day shipping and generally more generous return policies when you want to send something back. So that's where they're all kind of similar.
Okay, so what about... Oh, I'm sorry, go ahead. It broke up there for a second. Go ahead.
No, I was just going to say that each of them has a discounted tier for different groups, like Target credit card holders get a discount on their membership, as well as like students, people on government assistance.
So what about any extras? What unique perks do these programs offer as well?
Yeah, this could be the deciding factor, right? Target gets you shipping from its partner Shipped, which has deals with lots of other retailers. So Costco, Petco, Sephora, lots of places. So you can get delivery from those places with your Target membership. Walmart Plus gets you a streaming subscription to Paramount Plus, and Prime gets you a subscription to Prime Video, Prime, Amazon Music. So those are where they differ, and you might want to think about what your individual shopping habits are.
Molly Moorhead, thanks so much. I don't know, this might get me to kick the tires on an Amazon Prime subscription. We'll see. I'll report back for you. Thanks so much, Molly.
All right, you let me know.
All right, will do. Much more on wealth after the break. You're watching Yahoo Finance. Madonna, she once said, time goes by so slowly, but it definitely seems to hit warp speed this time of the year for those staring down the deadline to file tax returns. And there are still millions of Americans out there who have yet to get to it. A recent survey from Trustpilot showed that as of March 29th, a full 48% of Americans had yet to file their taxes. Of course, waiting till the very end comes with its own set of risks. So, to help make sure you get everything in on time, joining me now, we've got Kathy Pickering, who is the H&R Block Chief Tax Officer. Kathy, great to see you, great to catch up. First and foremost, I mean, the clock is ticking here. So, the last minute tip for those who are out there who haven't started right now, what would it be?
Hi, good to see you, Brad. Thanks so much for having me on today. And I just got to say, it's time to file. Let's get going. So my biggest tips are, if you haven't started, the first thing you need to do is get started. H&R Block has a great tax preparation checklist. You can print it out. It's a great way to go through and just check, do you have all the documents that you need in order to be able to file your return? If you do, there's still plenty of time to go ahead and prepare your return and get it filed. If you don't, then you may want to consider filing an extension, but an extension is not an automatic, don't pass go without paying $200 kind of a thing. There's things you need to know about filing an extension. If you owe money, an extension to file your tax return is not an extension to pay your taxes due. And that's the thing that a lot of people don't understand. And that can really be an important thing to know when you're considering your options here.
What if you know that you're going to be getting a refund, Kathy?
Well, then you still want to go ahead and file your taxes as quickly as possible, because the IRS processes refunds in, tax returns in a first in, first out basis. So if you are owed money, then you're just delaying how long it's going to take to get your refund.
Certainly. When you think about how people can estimate their taxes as well, I mean, there are certain tax calculators out there. What's the best way to go about using a tax calculator? Should those in the very technologically savvy era, like myself, like some friends, like family members out there, should they want to be able to tap into a tax calculator?
So I, of course, think that H&R Block's tax calculator is quite good to be able to estimate your taxes. But that said, there's many of options out there. However, the other thing you can do is, in order to avoid late payment penalties, is make your tax payments. So if you look at how much tax you paid last year and pay at least 90% of that, then you can avoid underpayment penalties, which, that alone can help save you a lot. And honestly, depending on how complicated your situation is, it's just as much effort to prepare your return as it is to estimate your taxes. So if you use an online system or, something like that, you can go ahead and prepare your taxes, even if you're not really ready to hit send to file your taxes, and just see what your situation is.
If you can't pay what you owe in full, what is the percentage threshold that you should be still submitting with the return?
So ideally, if you're paying at least 90% of what you owed last year, that's a good measure of thumb. The other thing I would say is there are so many options for paying how much you owe. So first, of course, you can just pay online with the IRS, do a direct debit from your bank account. But if you can't do that, you can pay with a credit card. And a lot of people like to do that, even if they could pay otherwise, but they can get those reward points on their credit card. So some people like to do that. Remember, there's a service fee for setting up that option. And if you really just cannot pay your balance due in full, it's best to pay as much as you can, because everything that you pay reduces any penalties or interest that would get accrued on the outstanding balance. And last but not least, you can set up a payment plan with the IRS to pay it off over time if you just can't pay it in full.
All right, just lastly, and I believe we have a nice little pretty full screen for this, so I do want to make sure that we show. We talked about it a little bit earlier on, and it's with regard to filing for the extension. The form that people need to know about, Form 4868, okay? And there we go. There's the full screen. So Run us through this and the key dates that people should also remember when they are filing this.
So the Form 4868 is the extension filing form, and it's really easy to do. So if you're in that situation where you just need to file an extension, you could go online to the IRS and print out this form, sign it, and stick it in the mail. But remember, it has to be postmarked April 15th. So you also want to check the date, the times of your post office to make sure that you're getting in before they close. It's easy enough to fill it out online. You can file it for free with the free file options. And the thing is that it has to be filed by midnight local time if you're filing it electronically. But it's very easy to do and so worth it to at least file the extension if you can't get your tax return in on time, because that failure to file penalty is 10 times more than the failure to pay penalty.
Kathy Pickering, thank you very much. H&R Block Chief Tax Officer joining us with the goods here ahead of the big deadline day. Thanks so much, Kathy. Appreciate it.
Happy filing.
Thank you.
Thanks.
We are just days away from the tax filing deadline, as we were just discussing, Monday, April 15th. Have you heard of it? You might be wondering how you'll pull it off in time. Maybe you'll try to enlist the help of an AI chatbot. But our next guest is here with some caution around using AI in full to help you file. Here with more, we've got April Walker, American Institute of CPA's lead manager of tax practices and ethics. Great to have you here with us. So why be wary of an AI chatbot or an AI bot?
Yeah, thanks for having me, Brad. And your previous guest reminds me I haven't filed my tax return yet. So I'm getting to that by Monday, like we said, Monday the 15th.
Right after this segment, April. We got time.
Yeah. So definitely. AI. So it's definitely a conversation that we are talking about a lot, how it's going to change people's jobs, how it's going to change so many parts of life. So some good things, some tips, I would say, like how to lean into AI. And that would be like, use it to help educate you on information about tax. You could ask commonly missed tax deductions, how income is taxed. I was playing around last night, just kind of preparing for this. And I said, hey, is this restaurant that I went to, this restaurant meal that I went to, is it deductible? So it's going to help you. It's going to help you, give you some information and prepare you for get you educated. However, tax is very complicated and nuanced, and it's not black and white. So that's where you would have some, you want to just be cautious, because also, we know that AI can give you the wrong answer, can take you down a road that is not right. But it's also, because tax isn't black and white, right? It might say, yes, this restaurant expense is deductible if it's ordinary and necessary, right? What does ordinary and necessary mean? That might mean something different to me than it means to you. So that's where I would say, lean into the information that these, amazing chatbots, ChatGPT, Microsoft Copilot can give you, but just be really wary.
Additionally here, April, just to throw this in the conversation, there are certain chatbots and AI that has been baked into some of the software that people leverage as well. How can they use that to their advantage?
Yeah, so, AI in general is not brand new. It's just like this generative AI has really just kind of exploded. But the chatbots in the softwares that commonly people use, they're asking you questions and trying to prompt you for things. So definitely use that to your advantage to help you understand things, help you understand what you might be missing. So definitely use that. There's also a ways. I was talking to my dad, trying to help him over the phone with things, and he was telling me about you could take pictures of things and bring up pictures into the into the software. And so like lean into that, like definitely use that to your advantage to help you so you don't have to key everything in. So, that's part of AI.
American Institute of CPA's April Walker, thanks so much for taking the time here. We release you so that you can get it done as well. You can get that filing in. Yes,
thank you so much.
Appreciate it.
Yep.
Everyone, we've got much more wealth after the break. You're watching Yahoo Finance. Slow news days no more. Earnings season is officially underway. Big banks, JP Morgan, Wells Fargo, and Citi all set to report their latest results, and they did this morning. But what even is earnings season? Well, it's a period when a substantial percentage of publicly traded companies release their quarterly results. Typically begins about 2 weeks after the end of the quarter and lasts around 6 weeks long. But why do investors care so much about earnings? Ross Mack is here with the answer. Why should investors care so much about earnings season? Ross, we've got rabbit season, we got duck season, we got earnings season for all of us financial heads and talking heads out there as well. What say you? Why should they care?
Well, one, right, I think earnings season is obviously just going to give us a report card of how companies are doing over the past 3 months, but it also is going to give us an overall glimpse of how the overall economy is doing. So first, we're looking at how the company did relative to analysts' expectations, right? Is the management team still doing well? Does that company still have competitive advantage, right? Do you still want to own this company? But also it's going to give you a sense of just how well the economy is doing. Are consumers actually spending money? Do they have discretionary spending, or are they saving, or savings down? Then another thing I like to look at is future guidance. I think that's very important to really get a sense of, one, what is the actual management team seeing for their opportunity set as well as their overall industry.
When it comes to monitoring these earnings reports as well and listening into earnings calls, it can be an information overload. I spoke with Chris Versace, who is the Tematica Research Chief Investment Officer, about some of the key themes for this earnings season that he's paying attention to, Ross. I want to play this clip for our viewers that are listening.
Guidance is going to be key. How do these inflation factors fit in? Are companies still spending in areas we think they are? AI, data center, cloud, infrastructure spending in other areas. That's what we're going to want to see. But if they're feeling the pinch of these, higher inflation pressures, does that mean that, those earnings expectations for the market have to come down?
And Ross, I want to get your reaction as well here. I mean, how can investors best pay attention to forecasts, to guidance, and what the company is expecting to happen going forward?
That's arguably one of the more important things when a company actually reports, right? After they report, the management team gives an earnings call. And on that earnings call, you want to look at, one, what are they seeing over the course of the rest of the year, where they're spending. Also, once again, the strength of the overall consumers, right? If we're looking at airline companies, we want to get a sense of, do they actually see discretionary spending picking up? Do they see people, now that COVID is done, people are returning to traveling, et cetera. So when I look at the actual earnings calls, I try to look at what's happening in the industry. Is there overall shift? Are they spending in different areas? And obviously, with that gentleman, he was talking about AI. And I think overall, earnings call gives you a great sense of where there's going to be areas of growth.
Ross Mack, thanks so much for taking the time here today. Happy earnings season to you as well as things shift into full gear. Banks kicking things off.
Thanks for having me, baby.
Absolutely. Well, Roku announcing a data breach in which hackers gained access to 576,000 accounts. This is the streaming company's second data breach this year. For more on how this could impact you, we turn to Yahoo Finance tech editor Dan Halley. Dan, what do we know about this so far?
Yeah, Brad, the first kind of breach happened with 15,000 Roku users' accounts. The company says this was through a method called credential stuffing. Essentially what that means is hackers or attackers took someone's username and password from one site and then said, well, people are dumb, they probably reused their stuff, and put it into their Roku accounts, and voila, they got access to 15,000 accounts. They went through, they studied that, and then they found a second incident where 576,000 accounts were impacted through the exact same way, where someone had said, people are dumb, we'll pull their username and password from X site and plug it into Roku, and bam, it worked. Roku says that they're working to mitigate this. They're resetting passwords for the affected accounts. They say in less than 400 cases, the attackers had actually logged in and then made purchases through streaming services related to the Roku account. So that means that someone went in and bought a movie or bought a subscription to HBO Max or something like that, or just Max. And it was a relatively small number. They also point out that the 576,000 is a small fraction of the 80 million accounts that they have. Now, I think the bigger thing to point out here is the account stuffing, the credential stuffing issue, right? So as I said, it's just a means where they take a username and password from one account and then push it into another account to see if it works. And look, I'm as dumb as everyone else, so I do the same thing. And so I think it just behooves everybody to use what's called two-factor authentication, where you'll get a text message or a notification for an app, through an app or email that you're trying to log in, and then confirm it that way. And this way, you'll A, get a heads up that someone is trying to log into your account, and B, they will get shut out when you don't approve that login through that two-factor authentication. But I mean, it really does just kind of speak to the general idea of cybersecurity hygiene of using different usernames and passwords. It's difficult, I know. As I said, I'm not the best at it, but I think two-factor authentication is a good way to try to play the best of both worlds.
Dan, what happens next? Is Roku likely to then reach out to some of the impacted accounts here? And what goes forward in terms of the data that was compromised and a potential legal action that might come forward as well, those who are looking for some type of settlement here as well?
Yeah, so they said that no major information was stolen. So things like credit card data, things like that, they weren't impacted. It's just that people may have had payment methods stored. And so, when you have a payment method stored on a website, you can just click a button and you can purchase something really quickly. I tend to try to not save my credit cards on websites. At least those I don't use very often because of this exact reason. If someone gets access to the site, well, then they can start buying stuff with my card. And while I have notifications turned on from my card, I just don't want that to happen at all. And I think as far as what Roku's doing, as I said, they're kicking those users out, the hackers, or they have already. They're resetting passwords. As far as legal action, I'm not sure exactly. This seems to be not an issue with Roku's accounts, at least according to this statement that they released, but just a general practice that people have where they just reuse login credentials. And so if you do that, you're setting yourself up for potential issues like this. Right. So I imagine that what's going to happen is we're just going to have people who have Roku accounts get notifications to update and turn on two-factor authentication, even if they weren't part of this, just so Roku can kind of cover its P's and Q's.
Yeah, and in that case, there would be no compensatory damages, maybe just some emotional damages out there for folks who had a hacker finish the series that they were only in the midst of and hadn't gotten too deep into. Dan, thanks so much for taking the time. Appreciate it. Well, coming up, everyone, more student debt forgiveness is coming. We've got much more on wealth after the break. Students, listen up. Student loan forgiveness. More of it is coming. The Biden administration announcing he will cancel $7.4 billion in student debt for 277,000 borrowers. But who stands to benefit this time around? Yahoo Finance's Rick Newman is here with the details. Hey, Rick.
Hey, Brad. We get another one of these student debt announcements every day, it seems. And this is not part of what Biden announced earlier this week. This is yet another debt relief program. So this one applies to people who are in what is known as the SAVE program. It's about 277,000 borrowers. And that tends to apply to people who have had their debts for 10 years or more. And this debt relief will apply to people based on family size and earnings. So if you have a larger family and lower earnings, you may qualify for this. There's a whole smorgasbord of these programs, these debt relief programs going into effect. They're going into effect on different timeframes. Some are being legally challenged and will take a while to go into effect, or may never go into effect. Others are going into effect pretty quickly or are already in effect now. A lot of this is automatic, but it's important if you have not been notified and you think you might qualify for one of these programs, you need to go to studentaid.gov. Find their page for debt relief programs and find out if you qualify, because they may miss some people, or you may be able to tell the government, hey, you qualify, even if they don't realize it. So there's a lot going on here, and make sure you don't miss out.
Where does this put the total number in debt relief programs at now, Rick, as we've seen multiple iterations of these move forward?
Right. So the total number of people who would be affected if all of Biden's student debt relief programs went into effect is close to 30 million at this point. And that's a lot. I mean, the huge program that Biden tried to put in place that the Supreme Court struck down last year, that would have helped about 44 million people. That's almost everybody, even if, not everybody would qualify for the full amounts of aid. There are about 44 million people with student loans. So this whole set of programs Biden has been announcing affecting about 30 million of those people. And the total cost at this point is about $660 billion. Now, again, that's if all of these programs go into effect, and this will take time. First, it'll take time for the Biden administration to put all the regulatory moves in place. And some of this may not happen until after the November elections, I should point out, which means if Biden is not the president and it's President Trump or somebody else who's a Republican, they could roll back some of this stuff. But just stay on it. If you're somebody who might be affected, just stay on it and make sure you are applying for everything you might be qualified for.
Rick, great word of advice there to end today's show. Rick, appreciate it.
See you, Brad.
See ya. Let's do a quick check of the markets here as we're taking a look at the major averages here in the U.S. The Dow, the S&P 500, and the Nasdaq are all in negative territory. The Nasdaq leading the declines on a percentage basis, at least. It's down by about 1.1%. However, on a point basis, you're seeing the Dow lower by about 300 points, equates to about 0.8%. The S&P 500 down just a little bit less than 1%. That's it for now. I'm Brad Smith. Thanks for watching. We've got much more wealth next week on Yahoo Finance.